Hi students, I am Prakash, Chartered Accountant and acting as academic advisor in Masterminds from the past 20 years. Here is a short video introducing matchless Masterminds briefly for the convenience of the students who came to this channel for the first time. Masterminds was established in the year 2002 and has been acting as a reliable platform to offer coaching for CA and CMA courses. Masterminds is undeniably the pioneer and the leader in MEC, CEC, CA and CMA courses with nearly 20,000 admissions per annum. This is an incredible initiative by three edupreneurs, namely Mohan, Radha and Prakash, that is me. All three qualified CA at a very young age of 21 years and started this organization under the mentorship of my father, Mr. M. Siv Prasad Garu. So Mr. Mohan is my brother and Radha is my sister-in-law. And by the way, it's me, Prakash, Chartered Accountant. So here are the courses for which we offer the coaching. We offer coaching for MEC, CEC groups exclusively at intermediate level. And we also offer integrated coaching for MEC along with CA, CMA Foundation. And we also take exclusive admissions for CA, CMA Foundation or CA, CMA Inter. And we also offer coaching for CA, CMA final level as well. Recently, we have started a unique academic program at intermediate level, that is MEC Pro, aiming for the students who want to pursue BBA or MBA or CLAT courses in future rather than CA or CMA, and we have received a huge applause for the same. So 20 years of experience, and we have finished more than 155 batches of CA or CMA Inter in Guntur alone and similar number of batches in all our branches together. So till now completed 17 batches of CMA Inter and 18th batch is going on. Successfully completed 25 batches of CA final till now and 26th batch is running now, and we have also successfully completed 4 CA or CMA final batches in Hyderabad. So till now our students are able to achieve 990 All India ranks at various levels of CA, CMA courses, and our students are able to achieve first rank for 48 times in various courses for which we offer coaching. So in a single year, our students are able to achieve 3 All India first ranks in the year 2020, and till now our students are able to achieve state first rank at MEC intermediate level for 18 times, that too 8 times in a row. In a single attempt, our students are able to grab 98 All India ranks at CMA Inter and final results of January 2021 and our All India ranks in February 2022 CA results. And here are the 10 All India ranks in CA final results of 2021 alone. And till now, our students are able to secure 93 All India ranks at IPCCR CA Inter level in the last 9 years. And here is our physical presence: Guntur, Vijayawada, Hyderabad, Amirpet, Dilshuk Nagar, Vizag, Tirupati, Kurnool and Rajahmundry. And here are the locations where we have branches. And here are the contact numbers. Here is the list of our physical presence and here is the list of our online presence. And for your kind information, we don't have branches in any other locations other than stated here. So please do install our Android app Masterminds Online Classes from Google Play Store, and if you belong to iOS platform, then install an app called Class Plus from Apple Store and enter the organization code as MZGUN. In this app, you can find a large number of useful content like regular batch videos, crash batch videos, rapid revision batches, guidance classes, motivational videos, amendment videos, Masterminds test series, whatnot. Large amount of useful content is already available in the app. In our app, you can find a section called study material where large amount of free content is also available. Until now, more than 24,000 students have already downloaded our app and we are nearing to 25,000. Sir, is it possible to interact with the directors directly? Yes. If it is an administrative issue, you need to contact Mr. Mohan sir on this mail ID. If it is academic issue, you need to contact me on this mail ID. So thanks to all our students who are our true brand ambassadors and who helped us to reach this position. All the best. As you already know, we have an app called Masterminds Online Classes app, and in this app, one of the most popularly purchased course is Rapid Revision Batch on the subject of Financial Management at CA Interlevel. So what we thought is it will be beneficial to large number of students if we make these videos available to students free of cost. That's why we have taken a decision to provide these videos free of cost to all of you. Let me introduce one of our faculties for financial management, Mr. Balasubramanian sir, having 20 years of experience, and he has taught all these videos of rapid revision batches in the subject of financial management. In just a matter of 25 hours, he has delivered the entire subject of financial management. Since the examinations are very nearby, in this short span of time, you will be able to revise the entire subject by watching the videos on financial management for just 25 hours. So my dear students, I am confident that you will utilize this service to the best possible manner.
Today we are going to start new chapter that is called cost of capital. In previous session we completed capital budgeting, and this session onwards I am going to deal with the cost of capital. Let's see a small presentation on cost of capital. In this chapter, what you supposed to learn, that is nothing but how to calculate cost of capital of the company. That is the straight point of this chapter. How to calculate cost of capital of the company. Do you know what are the steps, procedures, strategies to be followed to calculate cost of capital? That's entire aspects we are going to learn in this chapter. Let us take, actually, what is a cost of capital? Try to understand the basic element of cost of capital. Students, any company, what they do generally, they will raise funds from various sources and they do the business and they will earn a profit, right? This is the basic steps of followed by all the corporates, either it may be small scale or large scale or whatever the companies, right? All the follows the same strategy. Let's here in front you have a company, okay? This company need a, what is that capital? The amount or finance or money, whatever the terminology you can use it. To do business, you need a capital, okay? So that is nothing but a bulk amount to be required that depends upon what is it, the nature of the business. Here, this is the capital. This is a basic idea. Here is a company need a capital. It's nothing but finance it needed to start a business. But the point is, after estimation of this capital, how much is needed, the company plans to raise this capital from various sources. There are these sources being classified into broadly two categories. See, one is shareholders funds, another one is external borrowings. First of all, you understand clearly. The first golden line is when company need a capital, company makes an analysis how much is needed capital and it implements to raise the funds from various sources. The sources broadly classified into two categories. One is shareholder funds, another one is external borrowings. Shareholder funds means, shareholder, share. It means that the fund providers expect share in profit. That's why these are called, what is that, shareholder. Who are they? Equity shareholder and preference shareholders. Who are they means equity shareholders, preference shareholders. Here, equity shareholders funds consist equity share capital, that is nothing but direct owner share capital. Number two, preference share capital also. If it is a convertible preference shares are there, then you can you can say this would be what is that equity point of view also. So preference shares are two types broadly. One is a convertible, non-convertible. Non-convertible means it has a characteristics of a debenture. But if it is preference shares, which is a convertible in nature, in that case it has a characteristics of equity itself, right? That's why here equity share capital, preference share capital, sometimes retained earnings, any accumulated profit belongs to equity shareholders also comes under this category. So this is shareholders funds. What are they? Please tell me. Equity shares, preference share capital, equity share capital, preference share capital and retained earnings. Another one is external borrowings. External borrowings means you try to understand we are borrowing funds. We are raising loans. So here you can say loan from institutions, loan from banks and issuing bonds and debenture to the public and raising funds also comes under the category of what? External borrowings. These are the two categories. Okay. When company need a capital, company raises this capital from two broad categories. One is external funds, another one is shareholders funds. Let us take here, if you understand the both aspects, external as well as borrowings, you can have the following investors in that concerned group. Who are they? Equity shareholders, preference shareholders, debenture holders, as well as bankers or financial institutions. So if you need a capital, you can raise funds from equity shareholder, preference shareholder, debenture holder, as well as bankers. But the point is, when they provide the capital to you, do you believe that will they provide as a free of cost? Or do they give at a free of cost? No, they will charge some amount. They will charge some fees. They will charge certain extra amount what they pay, what they gave to you. What they give to you, right? So what is that? Equity shareholder. If you raise funds from equity shareholders, you have to pay equity dividend. For preference shareholders, you have to pay preference dividend. For debenture holders, you have to pay interest. For bankers, you have to pay interest for the bank as per the agreed rate. So, when you need a capital, you can raise this capital from various sources, no doubt at all. But the fund providers won't give at a free of cost, they will charge certain amount, right? They will charge certain amount. You see, equity shareholders, you have to, if I raise funds from the equity shareholders, I have to pay equity dividend. Fund from preference shareholders, preference dividend. Debenture holders, interest. Bankers, interest. The point is, I have to think that if I collect total funds from him, total funds from equity, preference, debenture holders as well as bankers. So what would be the aggregate cost I supposed to pay is called cost of capital. So that's why a question turns in my brain, that is nothing but how much does it cost? How much does it cost? Because I raised funds from all the parties, I have to pay cost to them. In aggregate for every 100 rupees, how much it would be the cost? That would be called cost of capital. Here you see I have to pay to whom? This equity shareholders, preference shareholders, debenture holders and bankers. I am raising all the members. So in considering all this concept, how much I supposed to pay is called what? Cost of capital. Have we got the question? Have we got the answer for this question? What is cost of capital? If you ask me straightly, cost of capital is the rate of return that the firm must earn on investment so that the market value of the company equity share does not fall. So I try to understand, cost of capital is the rate of return that a company must earn. Why? Because I raised funds from various parties, right? After raising that funds, what happened? I am going to make investment. So I must earn such a return because I have to pay the fund providers. So this is the cost of capital. If I am not able to generate the return in order to pay to my fund providers, automatically my market value gets down, gets collapsed. Why? Because the fund providers could not be in a peaceful manner. Certainly they will raise a question. They legally starts to fight against me because I have to pay. Got it? So that's why cost of capital is the rate of return that the company must earn on investment so that market value of the company equity share does not fall. I can say also like this, cost of capital is what? Rate of return that must be earned to pay to fund providers. What do you say? Got my point? So cost of capital is, it is nothing but rate of return must be earned to pay to fund providers. It's a return to be earned to pay to fund providers. At least you must earn this much. Okay. Now we will enter into the elaborative manner. These are the information which included in new study material. I am picked up that data and I am showing to you right now. So cost of capital is the Return expected by the providers of the capital. Who are the providers? Equity shareholders, lenders, means under the lenders, bankers, financial institutions, all the people, and the debt holder, debenture holders. So these are the fund providers who provides a capital to the company. Okay, so providers to the business as a compensation for contribution for the total capital. They contributed the capital to you. For that purpose, they will expect some benefit. So this is the cost of capital. I repeat again, cost of capital is the return expected by the providers of the capital. Who are the providers? Equity shareholders, preference shareholders, debenture holders, and bankers. All the people. So to the business, so it is a fund providers. This must be earned by the company in order to keep the market price alive. Okay, that is. So point is, cost of capital never be expressed in amount. It is always expressed in rate or percentage. Suppose 10% is the cost of capital. What do you mean of that? So this 100 rupees, for every 100 rupees you have to earn 10%. Okay, this 100 rupees you would have raised from various sources. That doesn't make any sense. But the point is, you 100 rupees you may raise from equity, preference, or debenture, or collectively. But for every 100 rupees you must earn 10%. Why? Because your cost is 10%. So cost of capital always expressed in rate or percentage, not in amount. That is one point. And another one is, it is also called cut-off rate. It is also called cut-off rate. It is also called what rate? Hurdle rate. We can also say it is a minimum rate of return. So what are the another name of a cost of capital? Cut-off rate, hurdle rate, and minimum rate of return. This is the cost of capital. I repeat, what is the 3 points? It is the minimum expected rate of return. Minimum return must be earned by the company in order to keep the expectations of fund providers. It is not always, it's not expressed in amount. It is expressed in rate or in percentage. Okay, cost of capital also called cut-off rate and hurdle rate and minimum rate of return. Right, coming to here, you see Coffee Day CEO who lost their life because he raised funds from various parties. Okay, so he done the business. He is not able to generate a return. At one point of time, he lost his life. So you see, when you can't able to generate a return, such a things will happen. This man lost his life. Okay, that's why whenever you are raising up funds, you must able to understand that what would be your cost and where you are utilizing these funds and how much return you are generating it. So if you don't have such a balance, then you will lose this. That's why, dear students, very careful with this subject, this chapter particularly, and you can understand very clearly. Okay, to calculate cost of capital, you should very clearly understand that determinants of cost of capital. So cost of capital is two aspects, you can say. You see, specific costs and combination of each source. When company raises the capital, first of all you should understand what are the sources in which the company raises capital, and you have to calculate the specific cost. Thereafter you have to sum it up in order to get overall cost of capital. So here, estimation of cost of capital includes the two basic steps. Step 1, estimation of specific cost. Specific cost means it is the cost associated with the specific sources. Right. For example, you see here, the company rises from equity. By issuing equity shares, company rises equity shares. Then you have to calculate KE, cost of equity. If company rises preference shareholders, okay, it has to pay preference dividend. So if you convert into percentage, then it would be cost of preference. For debt, it would be cost of debt. For retained earning, it would be cost of retained earning. So KE plus KD plus KR. If you sum it up all these things, you will get what? KO. That would be the next step. So could you understand what is the first step? Estimation of various specific cost. Could you please tell me various specific cost? KE, KP, KD and KR. By summing up of all these things, whatever you get, that is called weighted average cost of capital. This is also called KO. This is also called WACC. Okay, right. So these are the steps to be estimated. Next point is significance of cost of capital. Sir, what is the importance of cost of capital? If I can't learn cost of capital chapter, so what the disaster I supposed to face in my future, or where I fail as a CA professional? So is it damn essential for me to learn cost of capital? So here I am going to tell you the few important points. So if you clearly understand, then you can understand the importance of cost of capital. So number one is evaluation of investment options. Evaluation of investment options. You see, whenever we will make investment on various long-term projects or various fixed assets, generally we will compare return and cost. Particularly in evaluation of long-term project, we used to use a wonderful, beautiful method called NPV, right? NPV. To calculate NPV, cost of capital is essential, because if you want to calculate NPV, present value of future cash inflows minus PV of cash outflow, then only you will get it NPV, right? When NPV positive, then we will say that this project is worthable for investment. In order to calculate NPV, the future cash inflows must be brought into present. If you want to brought into the present of the future cash inflow, you must have the knowledge of cost of capital. When you don't know the knowledge of cost of capital, when you can't use cost of capital, tell me, how do you calculate NPV? When you can't calculate NPV, you cannot evaluate a project, right? So that's why, dear students, for investment decision, NPV is a wonderful technique. NPV positive, accept the project. So to calculate that NPV, cost of capital is essential. That's why I can say frankly here, without knowledge of cost of capital, you cannot evaluate a project. So instead of saying that NPV, try to think from the layman point of view, man. If you make investment in any project, you will generate a return, right? Return never be called return unless until it is greater than cost. This is a basic rule, right? A return never be called return unless until it is greater than cost. So you, by investing in a project, you are generating return. But how do you say that that would be good, that would be profit, that would be worthwhile, unless until you don't know the knowledge of cost of capital? That's why without knowledge of cost of capital, no one can take evaluation of a project. Point number one. Point number two, okay, performance appraisal. Performance appraisal, we can take it. Performance appraisal means how the company performing, how the company taking their financing decisions. By observing cost of capital, we can directly make a comment that this project is worthwhile. How do you say? Let us take company A is there, company B is there. Company A is there, company B is there. Company A overall cost of capital, that means it raised from various sources by spending 14%, whereas company B rising its funds, right, at 7%. Now tell me, which would be the best one? Company B, because its cost is very low. So once having the knowledge of cost of capital, you can make a comment that whether the project is worthwhile, whether the company performance is good or bad, you can make a comment. That is. Another one is designing optimum credit policy. Optimum credit policy. See, any company, if it wants to make more credit, more profit, if it wants to earn, now tell me, more profit I want to earn, more profit I want to earn, more sales I have to make. More profit I want to earn, more sales I have to make. More sales I have to make means more credit period I have to offer. If I want to offer more credit period, I must know that what is my financing cost, cost of capital. So if my cost of capital is high, I am unable to provide much credit period because I have a much responsibility to pay cost. So here the point is, when you have cost of capital, you can plan yourself that what would be the better credit policy. Can I give more credit period or less credit period, reasonable credit period? Basing on that, I can tune my sales. So that's most important. So to design an optimum credit policy, okay, credit policy, cost of capital knowledge is essential. A company's cost of capital is least. So its way of designing credit period, credit policies are different from the company which has huge cost, cost of capital. You see in some of the shops, right, they will hold a board that don't ask any loan. Don't ask any loan. If you go and ask them, sir, why do you put this board, don't ask loan, means why can't I ask a loan? Because he said, sir, this business capital I raised in the form of loan, sir. By raising loan, I'm doing business. So if I sell my commodity on loan based to you, then there would be a big slap to me, sir. It's very risky for me. So I have to pay cost to them. So that's why, sorry, sir, I can't sell any commodity on loan based or credit based. They will frankly say, because their cost might be high. So that would be the another reason. And another one is to assess the risk associated with the company. Risk associated with the company. Very simple. If you see the cost of, if you ask the cost of capital of the two companies, let us take a Wipro is there, Wipro is there, as well as ITC is there. Okay, you ask both the companies, what is your cost of capital, what is his cost of capital. So Wipro cost of capital is 20%, ITC cost of capital 30%, means which company cost is high? This company, ITC company cost is too high. So when cost is high, they must earn highest return. When they must earn highest return, they have to take highest cost, highest risk, right? So the company which has high cost must earn high return. Must earn high return means must take much risk. Or you can also consider that high cost is always high risky. That's why to evaluate risk element of the company also, by observing cost of capital, you can wonderfully make a statement with respect of risk element of the company. Got it, dear students? So these are the significance of cost of capital. Number 1, evaluation of investment options. Number 2, performance appraisal. Number 3, designing optimum credit policy. Number 4, to assess the risk associated with the company. Okay, that's next. We are going to enter into the calculation of specific cost. To calculate the weighted average cost of capital, we have to calculate specific cost. So step 1 I am going to take is calculation of specific cost. Under that, the first one I will take cost of debt. See, cost of debt. Whenever, why I pick this images, whenever you will raise the funds from outside by issuing debenture or bonds, so you have to pay a cost of debt to them. So whenever you rise, there would be a chain to your hand. There is a risk. Here this indicates risk. But if you understand the cost of capital concept clearly, you have a keys with it. It doesn't make any sense. Got my point? So when you raise funds in the form of debt, certainly you will have a locker. You would be locked. But if you understand cost of debt chapter clearly, you will find keys also with you. So you can comfortably remove these locks. So that's why very carefully listen and understand the concept. Okay, right. Here, cost of debt. Cost of debt is nothing but whenever company rises or issues a debenture, bonds to the public, and if it rises funds, that is nothing but a debt funds. For rising of funds, it has to pay some cost. Here the point is, what I would like to convey to you is, cost of debt is the, you see, cost of debt is the minimum rate of return that a company must earn from its debenture capital. Must earn from debenture capital. It issues debenture and it raised, it must earn the capital. So cost of debt is denoted KD. Cost of debt is denoted with KD. So in generally, cost of debt is nothing but coupon rate of interest. You see, when companies issues a debenture, there itself it promises to pay some rate of interest specifically. I will pay this much of rate of interest, 10%, 15%. So that would be nothing but it will promises to pay certain specific rate of interest. In general sense, I am not saying specifically, in general, cost of debt is nothing but, what is it? Coupon rate of debentures. Coupon rate of debentures. So here in general, but what are the factors to be considered? That is the most important. By considering some factors, Cost of debt may not be coupon rate of interest. Sometimes cost of debt, coupon rate of interest, both are same when there is no any factors. But the point is, when factors exist, then you have to calculate cost of debt very, very specifically. Here, what are the factors? What are the factors? Number one, issue made at discount. Whenever company makes issue, here let us take, this is the debenture company issuing. The coupon rate is 10%. They promise it 10%. Okay, they promise 10%. Now the point is, if the company issues these debentures, so less for 10%, it indicates what do you mean of this 10%. For every 100 rupees, the company promising to pay 10%. Company promised to pay 10%. Here, but if you issue as a discount, what happens? So you are issuing at 90. It means that the customer or the client providing only 90 to you, but on 90 you have to earn how much? 10%. In that case, indirectly you are saying that cost would be 10%, but indirectly 10 you are paying for 100. That means in that case it would be 11.11%. So issue made at discount, in that case coupon rate is less than cost of debt. So cost of debt may be high. Got it? So if nothing, then coupon rate, cost of debt both are same only. But when issue made at a discount means you are not receiving the optimum sufficient amount. Because of discount you losing some amount. When you lose some amount, automatically your risk element increases, with effect your cost of debt also increases. That is issue made at discount. Next one is issue made at premium. This is a good thing, right? Whereas a company 10% promises to issues 100 rupees debenture, but it collects 110 rupees. It collects 110 rupees. In that case, what happens? By spending 110 rupees, okay, company just able to generate 10 rupees only. Now convert into percentage. 10 divided by 110 into 100. Then it would be 9 point cost coupon rate. Coupon rate is greater than cost of debt. Or you can say here cost of debt is less than, made it cost of coupon rate. Here it is less, man, please. So when premium increases, then in that case cost of debt would be less. So here you can say KD would be more, here KD would be less comparing to coupon rate. Then third aspect, what is that? Third aspect is flotation cost. To try to understand what is a flotation cost. Flotation cost, also called issuing cost. Whenever security is to be issued in the public, you have to give some TV ads, you have to refer a bank, you have to print certain documents, and you have to procure some credentials, you have to give some advertisements. So such things are essential, right? All things are essential. Without that, you cannot make a calculation. So flotation cost means issuing cost. All this cost includes. So these costs also incurred by the company. But in order to incur this cost, where they will get the funds, right? So how much of money they will raise from the public, that amount only they will spend. From that amount only they will spend. It means that, try to understand, here 10% is the coupon rate. I am issuing 100 rupees a debenture to the public, right? A person, I issued a person. That person paid 100 rupees to me, right? But whereas I incurred 20 rupees of flotation cost, right? To understand 20 rupees flotation cost. That may be so far said expenses. 20 rupees flotation cost. In that case, even though I received 100, right? Even though I received 100, okay, but finally, how much amount will come to my pocket? Out of 100, I lost 20, means totally I will get 80. By using this 80, I must generate 10 rupees. In that case, if I convert into percentage, how much it would be? 10 divided by 80 into 100. Then it would be 12.5% is for every 100 rupees I must pay. But my coupon rate says just 10 rupees. The world will consider me as my cost is just 10%. That is not my cost. That is my coupon rate of interest. My cost of debt is 12.5%. The reason behind this is flotation cost. So dear students, when you incur more flotation cost, okay, you have to, when you incur more flotation cost, your net proceeds, the amount which you are supposed to receive is gradually reduces. With effect, your cost of debt increases. So that is also point. So flotation cost also point. When flotation cost is not there, then all the factors will remain same. Coupon means a coupon rate and cost of debt remain same. Another one is tax. So tax is a legal charge, must be paid as per the government norms. They will fix certain charge, cost, tax, and we have to pay. So here the point is, in cost of debt, because of tax you would be benefited. How, sir? Because generally you take a EBIT, from EBIT we will pay interest, right? EBIT, whenever you have a debt, from EBIT we will pay interest. EBIT minus interest you will pay, then you will get the EBT. That EBT is a taxable. It means that because of issuing of debenture, we are paying interest. Because of paying interest, we are reducing taxable income. Taxable income gets reduced because of your paying interest, right? You're paying interest. So when you are paying interest one side and you are reducing taxable income on another side, with effect what happen? With effect what happen? Your taxable income gradually reduces. With effect you are paying low tax. So this happens in cost of debt. So frankly speaking, in estimation of cost of debt, tax is very, very positive scenario. You will get the tax advantage. So point is, how much interest you pay, from that interest to the extent of tax rate, you will get the tax advantage. I repeat again, how much interest you supposed to pay, from that interest to the extent of tax rate, you will get the tax advantage. That is cost of debt. Cost of debt. So when flotation cost will be there, the cost of debt will increase. When tax is there, in that case cost of debt decreases because of tax advantage you will enjoy. So another one is redemption made at a discount. Redemption, sometimes if debentures are redeemable in nature, okay, after specific time frame, if company promises to pay redeem, in that case redemption made at a discount. So at the end of the period, you are not giving the face value, you are giving some less than the concern promised value. So discount you are getting means it is very, very a positive sign to company. In that case, cost of debt certainly reduces because you are paying money at a discount mode. But whereas another point, when redemption made at a premium, made at a premium, in that case what happens? So you have to pay some additional amount. In that case, your cost also increases when your burden increases because you promising to pay some additional amount. So these are the point to be understood, because if you understand clearly cost of debt, okay, you can also understand cost of preference very, very easily. That's why you can read carefully and listen my video once again. So it would be benefits to you, dear students. Okay, got it my point? So this is in generally cost of debt, coupon rate remain constant or same generally. If nothing factors are there, no factors are there. But if the given factors exist, in that case issue made at in that case coupon rate may not be equal to cost of debt. In that case cost of debt may be more than coupon rate, less than coupon rate. What are the factors? Issue made at discount, issue made at premium, flotation cost, tax, redemption made at a discount, redemption made at a premium. Okay, let us calculate cost of irredeemable debenture. First of all, you should understand what is a redeemable debenture, what is a irredeemable debenture. See, whenever company need a capital, company may issue debentures and promises to pay certain coupon rate to them, and they will raise the funds and they start to do the business. Okay, this is a basic line. But by issuing debenture itself, the company says to the debenture holders that, sir, I cannot redeem your principal amount. As long as company exists, your principal stays with the company only. But every year, I promise to pay certain percentage, agreed rate of interest. So it is theoretically okay, but practically irredeemable debenture doesn't exist, dear students. Because once you take any loan from any individual, you have to pay some cost, You cannot say that irredeemable debentures. So For theoretical point of view, we will take irredeemable debenture, but practically it is not there. Keep it in mind. So, irredeemable debenture, these are the debentures which are not redeemed by the issuer of the company. It's known as irredeemable debentures. Only interest would be paid. Principal amount never paid. Theoretically it exists, but practically it doesn't. That is. Here, how do you calculate this cost of debenture? How do you calculate this cost of debenture? Here indicates, you see, cost of debt equal to interest, but where you will get the tax advantage. I said just now, how much interest you will pay, from that interest to the extent of tax rate, you will get the tax advantage. That's why interest into 1 minus tax divided by net proceeds or market price. Net proceeds or market price. The point is, what is net proceeds? See, whenever you will issue any debenture, finally how much amount reach to your pocket is called net proceeds. By issuing debenture, after deducting some expenses or some charges, finally how much you will get it in your pocket is called net proceeds. For the net proceeds, what do you say? You will take a face value. How much debenture you issued, that is a face value, okay? If at all you issue for discount, deduct the discount amount. Suppose 100 rupees you issued. If it is a 10 rupees is a discount, deduct the 10 rupees. So finally that 90 would be net proceeds. Not discount, you went for premium. In that case, instead of discount, deducting discount, you add the premium. Let us take 20. 20 means you add, in that case you will get it a 120 would be the net premium. Thereafter you will have a flotation cost. So sometimes you will incur a flotation cost. If direct amount is given, no problem, directly you can take it. But whereas if flotation cost at 5% is given, again in that case you have to think that how should I take that flotation cost 5%? Shall I go for face value? Shall I go for issue price? So how should I go for? How should I evaluate? Basically for new study material, when there is no any specific assumption, just they have given some problems, they gave cost of flotation cost is just 5%, and the valuation, for the sake of valuation, amount of flotation cost, they have taken what is that issue price only. So you also take the same and write an assumption. In sometimes what happen, you may also go with what face value. You can also take face value, but write an assumption. So dear students, when there is no specific direction given in the problem with respect to calculation of cost of flotation cost, in that case you can take assumption. That assumption might be 3. Number 1, you may directly take face value, or you may directly calculate on issue price of the debenture, or you may go with like this, face value or issue price, whichever be the higher. You can also use these assumptions. So if your assumption varies, your answer varies, with respect to your decision also varies. But you see, in classroom you will sit and you read the problem. So problem is a person when you become a chartered accountant, when you sit in front of your client. As a student now, it is a problem. When you are chartered accountant, it is a person. He is a person and he will convey that. When you cannot speak to you and he cannot convey to you, in that case what happens? You can take an assumption. That's enough. When problem is specifically mentioned, there is no need to take an assumption. But if problem doesn't consist proper information, then you can take an assumption. Doesn't make any sense. That is with respect to net proceeds. For market price, what is that? Sometimes cost of debt is not only estimated by new companies, means newly issued companies, debenture they may issue it. Sometimes the existing companies also value that what is the current cost of debt basing on market price. So sometimes in stock market, the market price of debenture gets fluctuated. So basing on that fluctuations, they will identify what might be the risk element because of reducing market price, because of increasing the market price. So that's why existing companies also valuate cost of debt, but existing company they took market price, new company when you are issuing, so in that case they will take net proceeds. That's the only important point, you should keep it in mind. So dear students, now tell me what is the formula of cost of irredeemable debenture. interest into 1 minus tax divided by net proceeds are market price. Got it? Right. Now, here the point I have given, when should we use NP and when should we use market price? Net proceeds, newly issued debenture. So, to calculate cost of capital, there they will use the purpose behind estimation of cost of capital is to find exact cost. For market price is existing company market price in stock market. They will identify risk element. For example, if your debenture value gets down, so automatically your risk element also increases. Your debenture value increases, your risk element decreases. In order to know that, you have to find it out. Okay? Now, for example, you see the NSE, National Stock Exchange, various securities value increases, decreases. When value decreases, risk element increases, where you will calculate the cost of debt by taking market price. Okay, that's why the reason why I have taken. You see, State Bank of market price also fluctuates. If SBI issued a debentures, if the debenture value gets fluctuates, automatically values also, risk also changes. Okay. Now, here we do one problem for calculation of cost of irredeemable debenture. XYZ Limited issued 12% debenture, 100 rupees each. Calculate cost of debt in following case, assuming tax rate is 40%. I repeat again, XYZ Limited issued 100 lakh of 12% debenture, 100 rupees each, and tax rate is 40%. So, if debenture issued at par with no flotation cost, when debenture issued at par with flotation cost at 5% issue price, when debenture issued at a 10% premium and flotation cost of 5%, if debenture issued at 10% discount with flotation cost 5%, Now, how do we calculate? I repeat again, is there any redeemable period in this problem? No, it means that it is irredeemable. Okay, coupon rate is how much? 12%. Tax rate is how much? 40%. What is the face value of debenture? 100. Now, considering flotation cost, in first situation, no par, no flotation cost, only tax is there. So, tax advantage company can enjoy. So, tax advantage is a positive. With effect, cost of debt might be less than coupon rate. Coming to second aspect, if debenture issued at par with flotation cost of 5%, in that case tax is positive, flotation cost is negative. In this problem specifically they mentioned how much? 5% of issue price they have given. So directly issue price is 100, no premium because no discount, no premium. So 5 rupees. Tax is positive, flotation cost is negative. Coming to C, if debenture issued at 10% premium with a flotation cost 5% issue price, 10% premium, wow, it's great because you will get the premium. In that case, you have a double advantage. Tax is an advantage, premium is an advantage. Disadvantage is flotation cost 5% on issue price. And last debit, if debenture issued at 10% discount and flotation cost of 5%. Here, two disadvantages, one advantage. One advantage is tax is advantage, discount is disadvantage, and flotation cost. Because of having two negative signs, in last day situation, cost of debt might be high. That we are going to practically calculate it. Let us take. I made it here for the sake of making time saving. I made it this one. Problem 1. Okay. Estimation of cost of debt in each of the cases. Case A, case B, case C, case D. Got it? Right. Cost of debt formula. What is the cost of debt formula? Cost of debt equal to interest into 1 minus tax divided by net proceeds. I am not taking market price in this problem. Why? Because market price we are calculating for new company, new issuing company. Why? Because flotation cost. Because flotation cost exists. Okay. So 12 rupees coupon rate into tax percentage 1 minus 0.40 divided by 100. Right. I will check once again in live whether I have done it at any numerical error or not. Okay, 12 into 40% means 60% you are supposed to pay. 60% divided by 100 into 100. Yeah, that would be 7.2%. Got the answer. Right. Coming to second. 12 in 40% tax advantage you supposed to get it. So multiply with 60%, directly you will get it. In that case 12 into 60%, you will get 7.2 divided by, here you see net proceeds, face value minus discount plus premium minus flotation cost. In first situation, face value 100, no flotation cost 0, no discount 0, no premium 0. So that's why here 100. But in B case, here face value 100, no discount 0, no premium 0, but flotation cost is there on face value, that is 100 into 5 rupees, that means 5 rupees. So 100 minus 5, you will get the 95. So here in numerator you will get 7.5, right? So 12 into 60%, that is 7.2. 7.2 divided by 95 into 100. You will get it 7.58 percentage. 7.58 percentage. In coming to third option, 12 into 60%, this is 7.2. Coming to here, how do you get this 104.4? Let us take 100 rupees. 100 rupees. In situation 3, what is the situation 3? See, 10% premium with the 5 rupees flotation cost. So 10% premium with 5 rupees flotation cost means here 100 plus premium 10 rupees minus flotation cost would be estimated on 110, 110 at 5%. So 110 into 5%, you will get it 5.5 minus 110, then you will get it 104.5. This is a net proceeds. Now you take this value 7.2 divided by 104.5, then it could be 100, you will get 6.889. I may consider it is 6.89 percentage. Got it? Right. In case D situation, here 12 into 60%, 7.2 divided by, how do you get this 8.5? I will tell you here. 100 rupees would be face value minus discount is nothing but, in this problem you see the 10% discount. 100 into 10% means 10 rupees minus flotation cost on issue price itself. 100 minus 10, 90. So in that 90 they are valuing 5%. 5%. So 90 into 5%, that is a 4.5. 4.5 minus 90. 85.5 would be the net proceeds you supposed to get it. With that 85.5 you have to pay 7.2 considered into percentage. 7.2 divided by 85.5 into 100, that is 8.42 percentage. So this is the way to calculate cost of debt, dear students. Cost of irredeemable debenture. Okay. Now you try to understand in which aspect, in which case cost of debt is low, why? In which case cost of debt is high and why? That you should understand. That is a reason for learning this problem. You see, in C situation, the cost of debt is very, very low. Why it is low? Because in that case, company generates tax advantage. Company issues premium. Company gets what? Another point is flotation cost is there. Because of having tax advantage and having a premium, the company cost of debt would be very, very low in case C. Why in case D is highest? Reason is very simple. In case D, what happened? 8.42 percentage is there because there is a discount, there is a flotation cost. Because these two things makes coupon rate is higher than, cost of debt is higher than coupon rate. Simply come to a conclusion. After learning this problem, we can say that if anybody, any company, ultimate objective is to reduce the cost. In order to reduce, what you have to do is try to reduce flotation cost as possible as. Try to raise the funds at a least flotation cost. Then only you can reduce the cost. And another one is, instead of going discounting, try to go with the premium. So if you are able to issue premium, means try to understand how much of goodwill, status, standard in your society. So what are the things, what are the strategies required in order to go with the premium? You try to adopt such a strategies in your business instead of if you adapt that, you can go for the premium with the issue. For example, Reliance is there. If Reliance issues a share, they will go with the premium. If any new company comes with market to raise the funds, they will go for a discount. Okay, so this is the point. You try to create such a goodwill to issue shares at a premium in order to attract customers, in order to generate more premium. Okay, so these are the things, dear students. With this, we completed cost of irredeemable debenture. For every model, I will teach one problem, and finally we will enter into the weighted average cost of capital. We discussed the cost of capital and particularly irredeemable debenture problem also we solved. We are going to discuss redeemable debentures. Previous class irredeemable debentures, today's class redeemable debentures. So today's session with redeemable debentures cost of capital estimation. First of all, you should understand what is redeemable debenture is. Dear students, when company need a capital, it issues a debenture, it raises funds from the public called debenture holders. But once you raise the funds, it is your due respect responsibility to pay to them reasonable interest, and at one point of time you have to pay their principal amount back. So when a company issues a debenture, in debenture certificate itself is declares that whether the debenture is redeemable or irredeemable. So redeemable debenture, it indicates that it is an acknowledgement made by the company to debenture holders saying that either company promises you that after a specific time frame your principal amount will be returned back to you in the given conditions, in the given format. Okay, they will say, they may say that we redeem the debenture with a premium, we redeem the debenture with a discount, we redeem the debentures at a par value also, they may say that. That depends upon the terms and conditions. So in this session, how do we estimate cost of debt if debentures are irredeemable in nature? Okay, right. So let us come to conclusion, let us come to a point that if the debentures are redeemable, at the end of the period, the company has to make a redemption. Do you agree? Right. How the company is going to make a redemption, that depends upon the path we have to choose for calculation of cost of redeemable debentures. So whether the company is redeeming at the end of the period with a premium or par or discount at the end of the period. So that is the one aspect. Or whether the company is choosing a path that every year it will make some partial redemption from its principal amount. For example, a company raised a 10 lakh debenture. It may say that every year I will pay you the principal amount of a given amount or given percentage. Then it is called redeemable debenture, but payment should be done in two ways. One is lump sum, another one is on installment basis. So now I will show you, okay, how the redeemable debenture is estimated. Right. So cost of redeemable debentures. So it could be estimated in two ways. One is, point number one is, when redemption is done at lump sum and coupon rate remain constant, the rate of interest could not get fluctuated. The rate of interest will remain same. In that case, the approach is different. So here we will use a shortcut method. The two conditions should be implemented, that is nothing but redemption should be done at lump sum and coupon rate will remain constant. Thereafter, here redemption is done at installment. When redemption is done at installment, we will choose IRR technique. Where in IRR means the technique which we learned in capital budgeting. So what is the logic behind this is, here also we will calculate IRR from investor point of view. Sometimes we will also calculate company point of view. I will give you an explanation here. You see, this is the complete information with respect to cost of redeemable debenture. So first of all, you should understand what is a redeemable debenture. It is a debenture where company will redeem its principal amount at the end of the period at a given time period in a given way. Point number one. Number two, the cost of debenture estimation is depends upon the what pattern the company is going to redeem the principal amount. Point number three, company may assure the debenture holders that redemption may be done at lump sum, redemption may be done at installment. Number four, redemption done at lump sum lump sum, there is a chance to use a shortcut method. But to use the shortcut method, the two conditions has to be followed. Number one, the redemption should be done at lump sum and coupon rate remain constant. The formula to be used in calculation of redeemable debenture when redemption is done at lump sum is cost of debt equal to interest into 1 minus tax plus RV, means redeemable value, minus net proceeds divided by n number of years. Interest into 1 minus tax plus RV, redeemable. How you are redeeming? Are you doing redemption done at lump sum or installment? And NP, net proceeds, already yesterday we discussed. Net proceeds means face value minus discount R plus premium minus flotation cost. So divided by n number of years, then RV plus NP divided by 2. This would be the formula 1, right? So another area is redemption is done at installment. When redemption is done at installment, company may choose IRR path. So what is IRR? It is the maximum rate of return one can earn from the given project, or you can say it is the maximum rate of interest one can pay in order to undertake a project. That is also called IRR. But here the point is, IRR can be estimated from whose point of view? Investor point of view, which is similar to capital budgeting. In capital budgeting, we calculated IRR. After calculation of IRR, what the point you understand? So it is the maximum rate of return the investor would earn if he makes investment in the concerned project. Okay, it means that this man earning this much means the company is paying this much. For example, salary is a expenses, income to me, but the institution at which I am working is expenses to them. So salary is income to me, salary is expenses to them. How much salary I earned is my rate of return. How much this would be a cost to organization where I am working, right? So that's why what happened, instead of calculating directly how much cost paid to debenture holders, sometimes what the company do is they will calculate from investor point of view. This much of return my client has earned, so I'm paying this much of cost. That is the logic they developed in developing cost of redeemable debenture formula. Okay. Another one is when flotation cost tax exists. Okay. Flotation cost is a cost incurred by the company. So client don't know about this cost. And tax means interest is a tax allowable expenditure. So company pays a tax. But it will enjoy the tax advantage. Okay. It enjoys the tax advantage. This tax advantage information also customer is unaware of this. So that's why whenever problem consists of flotation cost and tax, so you are advised to calculate cost of redeemable debenture from company point of view only. Company point of view. In company point of view, exactly it is a cost, how much the company is supposed to pay. But in investor point of view, IRR is nothing but return. But how they will again make a matching of return to cost means investor by making investment in our company. So and so investor earned this much of rate of return. Since he earned this much of rate of return, since we paid this much of rate of return, that is the logic they will construct. So these are the information with respect to cost of redeemable debenture, students. Okay. Now finally, what is the cost of redeemable debenture? After specific time frame, the principal amount to be redeemed. How do you calculate cost of redeemable debenture? That depends upon the pattern of redemption must be made by the company. What are the patterns of company uses to redeem the principal amount? There are two. Redemption should be done at lump sum, redemption to be installment basis. What is a shortcut method? How do you use it? Shortcut technique is used only when company makes redemption at the end of the period, but the condition applies, coupon rate remain constant and rate of interest remain constant. Shortcut method formula: interest into 1 minus tax plus redeemable value minus net proceeds divided by n number of years divided by RV plus NP divided by 2. When redemption is done at installment, we will choose IRR. IRR, whose point of view IRR can be calculated? IRR can be estimated from investor point of view. IRR also estimated from company point of view. Point 1, when flotation cost tax exist, the both will exist, okay, or any of this exist, okay, the IRR should be estimated from company point of view but not investor point of view. If problem is silent with respect to both, particularly tax and flotation cost, company can calculate from whose point of view? Investor point of view. To calculate investor company point of view, these two conditions should exist. For investor point of view, normally you can calculate, okay, right. This is cost of redeemable debenture. With respect to this, I will solve you a problem. So let us read the problem number 3. A company debenture, not problem number 3, sorry, problem number 2. Problem number 2. Calculate explicit cost of debt for each of the followings. Okay, debentures are sold at a par, flotation cost is 5%. Debentures are sold at a premium of 10% and flotation cost are 5% of issue price. So debenture are sold at a discount of 5% and flotation costs are 5% of issue price. Coupon rate of interest on debenture is 15%. Face value of debenture is 100. Maturity period is 10 years. Tax rate is 35%. You see, debenture face value of the debenture is nothing but 100. Coupon rate of interest, that is nothing but rate of interest to be paid, is 15%. Tax rate is 35%. Redeemable period is 10 years. So the flotation cost exists is 5% in first option. Second option, premium 10% and flotation cost 5%. Third option, discount 5% and flotation cost also 5%. So we have to calculate cost of this debenture. Now tell me, is it redeemable, irredeemable? It is redeemable because redeemable period is 10 years. Okay, redemption, how company is doing? There is no any installment basis. So that's why we can take an assume it that redemption is made at the end of the period. Okay. Sir, how the redemption is done? Redemption is done at the end of the period, but redeemable value there is no data with respect to redeemable value. So that's why we take an assumption that redemption is done at par value itself. Okay, par value itself. So basing on this information, we will calculate this one. Since redemption is done at end of the period and coupon rate remain constant, so we are eligible, or we are eligible to use the shortcut method very, very comfortably. Tell me what is the shortcut method formula, please. Shortcut method equal to interest into 1 minus tax. 1 minus tax plus redeemable value divided by n number of years divided by RV plus NP divided by 2. So in this is the model to make you to understand how shortcut method is used. Right. For this, I made a small presentation for you. Here, this is the problem. Tax rate, debenture sold at 5%, and here debenture sold at par, flotation cost 5%. Debenture sold at premium 10% and flotation cost is 5%. Debenture sold at a discount 5% and flotation cost is 5%. Now, here I took some assumption for this one. Just now I told you, since redemption is done at lump sum, coupon rate remain constant, thus cost of redeemable debenture can be estimated basing on shortcut method, and redeemable value is assumed to be face value. At the same face value, the company is going to make redemption. This is the basic assumptions we take to solve this problem. Right, here I made it calculation for time saving. Here the point is estimation of, you can make it estimation of cost of debt in each of the following situations. How many situations we have? Situation 1, situation 2, situation 3 is given. So that's why what we made it, we estimated situation 1 you take it, situation 2 you take it, situation 3 you can take it. Okay, what is the formula for cost of debt? Tell me cost of debt, shortcut method. under the shortcut method, the formula would be interest into 1 minus tax plus redeemable value minus net proceeds divided by RV plus NP divided by 2. This is the formula to be used. Now we can calculate. Sir, here in first situation what happened? In first option you have, here you can calculate the net proceeds here. Net proceeds equal to face value minus discount or premium minus flotation cost. So flotation cost data they have given like this, only on percentage base they given. Flotation cost of issue price, they said it's specifically issue price. Okay, so here how much it would be? 100 rupees face value, issue made at par, so no discount, no premium, but 5 rupees you made it issue and you have to take a 5%. So 100 into 5%, 5 rupees. So 100 minus 5 rupees, if you got it, 95 would be your net proceeds. So here the formula, interest equal to 15%, 1 minus tax, 1 minus 0.35. Directly you can multiply with the 65% also. So 15 into 65%, 9.75 you will get it, 9.75. There 100 rupees you are paying to him, whereas minus 95 you are taking. So 100 rupees you are paying to him, 95 you received net, 5 rupees you got the loss. But here interest is nothing but per annual basis. This 5 rupees is loss over the period of 10. So make it divided by life 10, you will get it as 0.5. So add back to it. 0.5 means 15 into 65%, 15 into 65% plus 0.5, you will get it at 10.25. That is a net amount to be paid, divided by 100 plus 95 divided by 2. So 100 plus 95 divided by 2, 100 plus 95 divided by 2, you will get it 97.5. So now above value if you multiply it, you will get it so 10.51 percentage, 10.51%. You can make it simply like this, 15 into 65%, right, that is a 9.75 plus 100 minus 95 divided by 10, you will get it as 0.5 here. Okay, whereas in denominator 100 plus 95 divided by 2, you will get it 97.5. okay, so 9, now you check it, 9.75 plus 0.5, that is a 10.25 divided by 97.5 into 100, you will get it at 10.51 percentage. This is the procedure. You can make first a simplification, then you can calculate it. The same technique you can also follow here. So 15 into 65%, 9.75 you will get it. Okay, whereas plus 100, whereas here what happened in second situation? What is the second situation? Tell me please. Debenture sold at a premium, flotation cost is 5%. In that case 100 rupees the face value, okay, plus premium 10 rupees. Flotation cost is estimated is on issue value, okay. In that case 110 into 5%, take it. So 110 into 5%, how much? 5.5. 5.5 minus 110, you will get it 104.5. 104.5 would be the your net proceeds. Now 100 minus 104.5 divided by 10, you will get it 0.45. So 9, thereafter 100 plus 104.5 divided by 2, you will get it 102, 102.25. So 9.75 plus 0.45 divided by 102.25. Here 100, this is minus, actually 100 plus minus 104.5, 4.5. 9.75 minus 4.5, 9.75 minus 0.45, 9.3 divided by 102.25. Yes, this is 9.10%. Just you practice it, you will get it this one. And similarly in third option, 5 into 1 minus 0.05 means you can take it as 65%. 15% into 0.65 plus 100 divided by, here you have to calculate in third option what would be the flotation cost left to you is debenture are sold at a discount of 5% and flotation cost is 5%. In that case what happened? 100 rupees is the face value minus 5 rupees flotation cost. Okay, flotation cost is estimated on not 5 value. Here you see debenture sold at 5%, flotation cost is estimated on issue 5%, discount is 5 rupees. Okay, in that case 95 minus 95 into 5%. So if you estimate it, it would be 11.27% you will get it. I will check the answer. 15 into 65%, 100 minus 90.25 divided by 10 whole divided by 100 plus this one would be plus 90.25 divided by 2, so 45. Next, yeah, it would be 11.27%. Yes, 11.27%. Dear students, this is the way to calculate the cost of redeemable debentures, okay, by using shortcut method. So this is the one most important logic to be implemented. So with this cost of irredeemable debenture we completed cost of redeemable debenture with respect to redemption made at lump sum. So there is a one more discussion, that is with respect to redemption is done at installment basis also. I will show you. Let's next we will enter into the another technique. Okay, dear students, after completion of cost of redeemable debenture, but redemption is made at the end of the period, that is a lump sum at the end of the period, that problem model is completed. Now we are going to know and understand and going to learn how redemption, when company makes redemption on installment basis, how the cost of debt to be estimated. For that we will use what is that, one of the wonderful technique, that is nothing but IRR. Let us check the problem number 4. A company has issued 15% debenture aggregating of 1 lakh. So company issued 1 lakh debenture. The flotation cost is 15%. The flotation cost is 15%. The company has agreed to repay the debenture par in 5 equal annual installments starting at end of the year 1. The rate of tax rate is 30%. Find the cost of debt. You check this problem. What is the coupon rate? 15%. What is the aggregate amount raised? 1 lakh rupee. 15% it indicates for every 100 rupees they are paying 15%. That is a coupon rate is 15. Okay. The company is repaying its principal on installment basis. Installment basis they are paying. How many installment? 5 installment. So in this model, shortcut method cannot be used. Can't be used. Okay. And the present value factors also they have given. Since redemption is done at end of the period, we have to use IRR technique. But here the point is, tax rate is given 35%. Tax rate is given 35%. That's why company enjoys a tax advantage. So this information doesn't know to whom? Our client, our debenture holder. That's why you have to find it out the cost of debenture by using IRR technique, particularly from company point of view. Whenever you are going to use or calculate IRR from company point of view, so you should understand the most important information is, if you want to calculate IRR, you must need 2 things. One is inflows, another one is outflows. First you should understand inflows as well as outflows. Here from company point of view, if you calculate, first what happened? First inflow will come, then outflow will come. Basing on that inflow and outflow and given factor value, you can calculate IRR, okay, by using interpolation technique. Let us check it this problem. So, estimation of cost of debt basing on IRR from company's point of view. I am clearly mentioned here, estimation of cost of debt basing on IRR from company's point of view. Ask me, why should I take company point of view, sir? Why don't you take from investor point of view? Dear students, tax advantage the company enjoys. So this information can't known by who? Investor. He don't know that company enjoys a tax advantage on interest. So that's why in that case you should calculate IRR from company point of view. First thing is you have to find it out net proceeds. Net proceeds is, what is the formula net proceeds? Face value minus discount plus premium minus flotation cost. But in this problem, if you observe it, there is no discount, no premium. Issue made at a discount, issue made at a discount, issue made at a premium, the information doesn't exist. So that's why we took assumption that issue made at a par or face value itself. Now flotation cost. So flotation cost is how much they said it. It is clearly mentioned in the problem. You see, 15%. So flotation cost is 15% is given. Right. Now you should consider here, already I told you, estimation of cost of debt basing on IRR from whose point of view? Company point of view. So net sale proceeds, face value minus flotation cost. 1 lakh minus 15% flotation cost, that is nothing but 85,000. 85,000 you will get it net proceeds. Okay, now you try to understand what is the cash outflows and cash inflows. First of all, I made it as some working note. Estimation of post-tax cash outflows. Estimation of post-tax cash outflows. So total how many years? I took first column here. Here 1, 2, 3, 4, 5 years. So problem clearly mentioned over the 5 years the principal amount to be redeemed. Total amount you taken is 1 lakh rupees. Equally over the 5 years you are paying means 20,000, right? First year 20, second year 20, third year 20, fourth year 20, fifth year 20. This I am paying. Along with this principal amount, I have to pay interest. But in that paid interest, company will enjoy a tax advantage. So how much, you know that rule, how much interest you will pay from that interest to the extent of tax advantage company will enjoy. So that's why from 1 lakh rupee, how do you get it? Here you see 1 lakh rupee, company pays 15% interest. Do you agree? 15%. From that 15%, company enjoys a tax rate which is given in the problem is, how much the tax rate is given in the problem is 35%, right? 35% tax advantage it will get it. So only it will have a cost of how much? 65%. Now you take it 1 lakh into 15%. This is 15,000 interest to be paid. Out of that you are getting 35% of tax advantage. In net you are supposed to pay 65% only. 65%, 9,750. Similar to coming to here. So in first year you paid a 20,000. So the interest to be paid in next year would be 80,000. So 80,000 into 15% into 65% tax advantage. Here second one, 80,000 into 15% into 65%. 7,800 rupees. Yes, this is also right. Third year, 60,000 into 15% into 65%. In that case, 5,850. 60,000 into 15% into 65%. 5,850. This is also right. Third one, 40,000 into 15% into 65%. So 40,000 into 15% into 65%. 3,950. Right. This is also right. Next 20,000 into 15% into 65%. So 20,000 into 15% into 65%. You will get it 1,950. 1950. Now the company has to pay interest plus principal both. So you add both this. So you will get it in first year 29,750 would be the net cash outflow to be paid. Second year 20 plus 7,800, 27,800. Third year 5,850 plus 20,000, 25,850. Fourth year 3,900 plus 20,000, 23,900. Fifth year 1,950 plus 20,000, 21,950. This is the every year cash outflows to be paid. Here post tax interest indicates what is it? Interest into 1 minus tax. So here what happens means the company when issues a 1 lakh debenture, 15% flotation cost goes means, so 85,000 it will get it. With respect of taking 85,000, it has to pay the cash outflows 29,750. First year 27,800. Second year 25,850. Third year 23,900. Next year 21,950. Right. Now we calculate IRR. So estimation of cost of debt basing on IRR from whose point of view? Company's point of view. Why? Because flotation cost cum tax rate both exist. So here you seek it. So in zero period, you will have to pay, you will receive inflows. You will receive inflows. Actually 1 lakh you issued, but out of that 15% flotation cost gone. So net amount to be received is 80. Since present value factor they have given a 15, I took the 15 equal to 15. So 85,000, 1 lakh, out of 1 lakh 15% gone out. So 85,000 we got it. This is the your inflow actually. It is your inflow. First year this is the cash inflow 29,750. Second year 27,800. Third year 25,850. Fourth year 23,900. Fifth year 21,950. So in the problem they have given it is the factor values itself. So problem they have given. If not given also no problem. 99% they will give you factor value. If not there, take a probable trial and error method. Take any of guess rate, calculate NPV, then find it out. So here this is the values. I took the first 15%. 15% means if you don't know factor value, you can use the calculator. By using calculator also you can trace it out. 1 divided by 1.15. 1 divided by 1 plus r whole square n. That is the formula to be used. So here you will get it. See, actually 0.869 given. I took it to 0.870. Then 0.756 correct. 0.757 correct. 0.717 actually is there. So that's why I made it 2. Next 0.497 I took it. Right. If you multiply both, how much? 29,750 into 0.870. That would be 25,882.5 is given. Okay, I made it 25,883 roughly. Next one 27,800 into 0.75, 27,800 into 0.756, that equal to 21,016.8. I got it. So I made it here 21.017. Next 25,850 into 0.657, that equal to 16,983. Directly I got it. 0.4 is given. I removed that one, so I couldn't consider that one. Next 23,900 into 0.572, that would be 13,670.8 given in the problem, means factor value point. So that's why I took it 13.671. Thereafter 21,950 into 0.497, that equal to 10,909. So this is with respect to 15%. I calculated at 15%. So at 15% what happened? I estimated. So 25,883 plus 21,000.17 plus 16,983 plus 13,671 plus 10,909. It would be 88,643 minus 85,000. You will get it at 3,463. Is it negative actually? Negative. So at 15% you got the negative, 15% you got the negative, then you have to move for 20% because you are calculating from investor company point of view. Since your cash outflow is the difference, your cash outflows are different from investor point of view. That is the reason at highest guess rate you will get it NPV positive and lowest guess rate you will get it NPV negative. Right, this is at 15% I got the negative, so I moved it to 20%. 20% factor value, 1 divided by, just now I tell 1 divided by 1 plus r whole power of n, 1 divided by 1.20, that would be 0.33 is the first year, yes I got it. Second year 0.694 I got it. Third year 0.5787 is there, that's why I took it 9. Next fourth year 0.492 given, so I took it 0.2. Next 0.40187 is given, that's why I had taken this value, right? Let me, in front of you, let me calculate again. So 29,750 into 0.833, that's I got it 24,781.75 got it, but I took it here 24.792. First year confirm, good. So next 27,800 into 0.694, that we got it 19,293. Next 25,850 into 0.579, we got it 14,967. Next 23,900 into 0.572, that would be 23,900 into 0.482, that would be 11,520. Thereafter 21,950 into 0.402, you got it 8824. So this is the way in which you can calculate at 20% NPV by summing up of 24,782 plus 19,293 plus 14,967 plus 11,520 plus 8,824. Summing up of after this, if you deduct outflow would be, you got the positive worth of 5614. Now you got the, at 15% you got the NPV negative, at 20% you got the NPV positive. You can use the interpolation. So interpolation formula, L1 plus NPV at L1 divided by NPV L1 minus NPV at L2 into L2 minus L1. So IRR equal to cost of debt 15, coupon rate is L1 15, NPV at L1 3,463, NPV at L1 3,463, NPV at L2 5,061, L2 minus L1, 20% minus 15% equal to 5. So if you estimate it, so 3,000, you see it, 3463 plus 5614, it would be 9,077. Okay, so 3463 divided by 9077, so 0.381 into 5 plus 15, okay, it would be 16.9%. 16.9%. So dear students, so this is the way in which cost of debt to be calculated. One specific cost is completed, and you know that I am saying now just one specific cost is completed, but actually two I completed, preference shares also. How? That's I am going to discuss. But with this session I completed specific cost estimation of cost of debenture, redeemable, irredeemable, and you should not forget interest is tax allowable expenditure. So next we will move into cost of preference. Cost of preference. How do you calculate preferences? Cost of preference is this session discussion. In cost of preference shares are those shares which will get the preference comparing to equity shareholders with respect to payment of dividend, with respect to payment of preference shares. So the point is, preference share capital is paid at a different specific rate. Preference shares are those which carry certain preferential rights in the payment of dividends and at the same time payment of when principal amount at the time of company winding up. So principal amount at the same time principal amount and regular cost. These shares carry certain specific rights, like debenture only it will hold. Preference shareholders doesn't have any voting rights, so that's why ownership does not get any type of dilution, but there is a risk element. But comparing to debenture, preference shares have less riskier. So less riskier because there is no any mandatory to pay the cost of preference. At current scenario, if you can't pay, in future you may convert into equity. So one point I would like to say, debenture will get the tax advantage, but preference shares doesn't get tax advantage. Sometimes company may go for to pay some dividend distribution tax. That is a burden to the company. Company may assure to the preference shareholders, I will pay this much of preference dividend, but if this preference dividend income to you, if you are going to pay tax on this dividend, so that dividend, that tax which you supposed to pay on preference dividend tax, that is also sometimes a company may bear. In order, this is nothing but giving too much of preference to preference shareholders. Okay, right. Generally, preference shareholders also estimation, there are two types of preference shares. One is a redeemable preference shares, another one is irredeemable preference shares. Already how we discussed irredeemable debentures, same to same, nothing else. See, cost of preference estimation, cost of debt estimation, same to same. There is no any difference between these two. Right. Cost of irredeemable preference shares. What do you mean by irredeemable preference shares? Cost of preference shares which are not at all redeemed, its principal amount to whom? The preference shareholder. That is called cost of irredeemable preference shares. How do you calculate cost of preference shares? Means this is the formula to be used. Preference dividend into 1 minus DDT, and means dividend distribution tax. Dividend distribution tax. Preference dividend divided by dividend distribution tax divided by net proceeds or market price. Net proceeds means the companies which newly issues a preference shares. Market price means that is existing companies. If the market value gets down, in that case they will also go for estimation. So preference dividend, here the formula is preference dividend, and P0 is nothing but preference dividend, MP0 is nothing but market price, NP represents net proceeds. Net proceeds formula, you know that, face value minus discount minus flotation cost, or plus if at all premium is there, then you can add the premium back. This is. Now in this model, how the preference shares are estimated. This is the problem which is given in our material 43 addition. I will show you in 43 addition preference shares. Problem number 8 is given. So I am going to do problem number 8 to make you to understand how irredeemable preference shares are estimated. So problem number 8. A Limited issued, that is A Limited only, you know, sure? Pal Subramaniam ji, are you sure? Yes, I am sure. See, A Limited issued 100 lakhs of 12% preference shares, 100 rupees each. How much the coupon rate? 100 rupees. So how much, sorry, face value 100, coupon rate is 12%. For 100 lakh they issued. Calculate cost of preference shares in each of the situation. Dividend distribution tax is 20%. So company is taking burden of dividend distribution tax. So if preference shares are issued at par, no flotation cost. This is the first condition. Number 2, if preference shares are issued at a par with the 5 rupees of flotation cost. If preference shares are issued at a 10% premium with the 5% flotation cost. If preference shares are issued at 10% discount, 5 rupees flotation cost. See, flotation cost is given. Balu sir, how do we calculate flotation cost? Because percentage is given, direction is ignored. At what direction we have to take? That is important. Should we go for face value? Should we go for issue price? Whatever the technique you can take it, it doesn't make any sense. So Now flotation cost equal to, what is the formula? Face value minus discount, if at all, premium minus flotation cost. Flotation cost can be estimated on net face value or issue price, whichever may be, but I take an assumption that face value is going to, flotation cost is going to estimated on issue price. Let us check the answer. Okay, for time saving only, I made it my own handwriting, I scanned it and I brought it to you. Okay, right. Estimation of cost of preference each of the cases, particularly irredeemable preferences. Irredeemable preferences. Got it my point, dear students? There are three cases are given. One is case A, case B, case C and case D. So first case, in each case, first you should calculate what is the preference dividend. You see, preference dividend. In the preference dividend, company has to pay tax also. Then in that case, preference dividend not only cost, preference dividend is the cost to the company, but the company should to pay dividend distribution tax on also. So preference dividend into 1 plus tax rate. So coupon rate is how much? 12. Is it 12 only? I think 15. 12% only. 12%. So 12%, but company is accepted to pay 20% on tax. So 120. Then it would be 12 into 120 percentage, that is 14.4. Here also same, everywhere 14.4, 14.4, 14.4. Second one, how much net proceeds you will get it? Net proceeds equal to face value minus discount or plus premium minus flotation cost. Okay. In this first condition, there is no premium, there is no discount, even there is no flotation cost. That's why we got a 100. Whereas in second situation, the gone with what? The second situation is what? No premium issued at par with the 5% flotation cost. So their issue price is 100. That's why 100 into 5%. You got it 5 rupees. So 100 minus 9, 95. In third situation, premium with 10%, and flotation cost is 5. So 100 rupees face value, premium 110, flotation cost is estimated on issue price. So 110 into 5.5%, 110 into 5 point, that is a flotation cost. You take it, then you will get it a 5.5. Okay, so 104.5. Whereas in second situation is 5% flotation cost, discount is 10%. In that case, 100 minus 10. So you will get it 90, and that 90, it is nothing but a 5%. So 405. In net you will get it 85.5. Now you can calculate cost of preference. Cost of preference equal to preference dividend into 1 plus tax divided by net proceeds. So that equal to 14.4, 15.14, 13.78 and 16.84%. So this is the way to you can calculate. So for example, you see it, preference dividend into 1 plus tax rate. This value, this numerator that we calculated here, that equal to 14 point. Net proceeds calculated here. Net proceeds calculated. So 14.4 divided by 100, you will get it 14.4%. In second situation, 14.4 divided by 95, you will get it a 15.156. That means 15%. Second, 14.4 divided by 104.5%, that equal to 13.78%. Next, 14.4 divided by 85.5 into 100, that equal to 16.684%. Okay, you can take verification. Nothing I calculated practically, I am showing you. So this is the way to calculate cost of preference shares. Coming to, this is cost of preference particularly with respect to irredeemable. So redeemable, again same how we calculated cost of debt. For that model also in our material there is a problem. I will show you there. Problem number 9, XYZ Limited issue 200 10% preference shares, 100 rupees each, not 200, 2000. 10% is the coupon rate shares, 100 rupees each at a 95%. The company proposes to redeem the preference shares at the end of 10th year. From the date of issue, calculate cost of preference. Tell me here any installment payment? No. In that case, directly we can calculate by using shortcut method. What is the formula for shortcut method? Cost of preference equal to preference dividend plus redeemable value minus net proceeds whole divided by n number of years divided by RV plus NP divided by 2. So, preference dividend how much? 10. Redeemable value nothing is mentioned, 100 minus net proceeds 100 rupees you issued, you got the 95, take 95 divided by number of years, how many years? 10. Resolve the numerator, divided by 100 plus 95 divided by 2. Resolve, convert into percentage. Coming to here, 100 minus 95, you will get the 5 divided by 10, you will get 0.5 plus 10, 10.5 is the numerator, okay. Whereas 100 plus 95 divided by 2, you will get it 97.5, convert into percentage. By taking 97.5, company is supposed to pay 10.5% of 10.5 of preference dividend. Convert into percentage. 10.5 divided by 97.5 into 100. You will get it 10.769. That is nothing but 10.77. This is the way you should calculate cost of redeemable preference shares. So with this, cost of debt I completed, cost of preference is completed. So next session I am going to take it, that is nothing but this is once again the PPT I prepared to show you at a time how do we calculate cost of redeemable preference shares. Now we have another alternative. Most important point is estimation of cost of equity. The fact is, what is cost of equity you should understand first. Cost of equity is nothing but whenever a company raises funds by issuing equity, the company how much must earn from the funds raised in the form of equity is called nothing but cost of equity. It is the minimum rate of return that a company must earn from its equity share capital. It is denoted as KE. Generally, there is a much contradiction with respect to cost of equity, because when we raise funds from the equity shareholder, we say that equity shareholders are the owners of the company. If the owners of the company, if equity shareholders are really owners of the company, then is it mandatory to pay cost to equity shareholders? So some members say that no. Okay, that is the one point. But FM what argues that risk must be rewarded. Among the given debenture holders, preference shareholders, who is the person who is taking much risk? Who is taking much risk? Nothing but whom? Equity shareholder. That's why these people must be paid more comparing to any other sources. That's why there are different types of techniques are evaluated to provide cost of equity. Which company, which method pays, that depends upon them, but we must aware of all the methods evaluation. Dear students, here the cost of equity capital dividend price approach, earning price approach, realized yield approach, CAPM approach. There are different types of models are estimated. Now I am going to show you a slide which consists in detail information of how to estimate cost of equity. So here the point is number 1, dividend model. So under this dividend model you have two models, no growth in dividend, another one is growth in dividend. These are the models which is available, you see. First one is dividend model, no growth in dividend, constant growth in dividend. Another one, EPS model, no growth in EPS, there is a growth, that is constant growth in EPS. Thereafter total yield model, thereafter CAPM approach. So these are the 4 techniques which is given in your study material that I projected here. This is institute material. what is it, scanned it, and I am showing there. First one, we will come to constant, no growth in dividend. This is the first model. No growth in dividend. What is the no growth in dividend? You see, growth, when you will have a growth, when company earns income belongs to equity shareholder. Generally, if you observe, company generally makes a sales. From the sales, variable cost, contribution, fixed cost, EBIT, interest, EBT, tax, EAT, minus preference dividend. If after deducting all, company will get earning availability to equity shareholders. Divided by number of equity shares, if you make it, you will get the EPS, right? EPS is there. Now the point generates here is, if the company EPS is there, if EPS company, from the DPS, company may hold certain amount, that is called a retaining ratio. 100 rupees EPS, if company plans to hold 60% in office, then it is called what? 60% if it is retaining ratio. The percentage of earnings of equity shareholder, instead of distributing them as a dividend, if company retains it, then it is called a retaining ratio. If 60% is retaining ratio, then 40% is the dividend payout ratio. If 90% is the dividend payout ratio, 10% is the retaining ratio. If company declares 100% dividend payout ratio, then there is no difference between EPS and DPS. See, when a company, every individual life growth, when it happens, for example, Masterminds pays a salary to me, right? How much salary it pays, if I spend the total salary now itself, immediately this concerned months itself means, will you identify growth in my life? No. Why? Because the total amount, how much I am earning, now I am spending totally. In that case, how should I increase, how should I find growth in my life? The same thing also in no growth model, company follows 100% dividend payout ratio. This model, I have added a valuable, very information to you, dear students. This model is applicable to stable and standard earning companies. No growth model, this model also called no growth model, it is also called zero growth model in dividend. No growth in dividend. Why growth in dividend? How much earning per share would be there? That should be earning per share, how much company earns earning per share. That can be identified company in two ways. One is retaining ratio and dividend payout ratio. If 100 rupees is the earning, if retaining ratio is 50%, dividend payout ratio is a 50%. Retaining ratio, it indicates amount of retained from the earnings by the company from its EPS. Dividend payout ratio also you should understand. Percentage of amount of dividend to be declared from EPS. If growth rate, when a company earns a growth rate is nothing but retaining ratio into rate of reinvestment. Then only company will earn. How generates a growth rate? For example, how much I earned, from that how much I spent, the remaining balance how much I retained it. The retained amount, if I invest somewhere else, I will get the growth. If no retaining, in that case there is no chance of growth. That's why here also company declares 100% dividend payout ratio or 0% retaining ratio. Company, how much amount earns, it declares to equity shareholders. In that case, EPS or DPS both are same. EPS or DPS both are same. Why? Because company declares 100% dividend payout ratio. When company, instead of holding single amount belongs to equity shareholder, if it declares 100% dividend payout ratio, then where should it invest the funds? Because you don't have a funds, you are empty hand now, because you are declaring 100%. That's why there won't be any growth in the company profile. So company rate of return, reinvestment or investor expected rate. Here the point is, why the company declares 100% dividend payout ratio? The reason is very simple. Investor earning rate is better than company's rate is there. In that case, you can retain it. But if investor rate is better than company rate, so it is a better to declare 100% dividend payout. So in this, equity shareholders expects only cash dividend. These people expect only cash dividend. They won't expect any appreciation in market price, and they don't want to get any capital gain. They don't want to get. They will ask you, you give it only our dividend itself. So that's why, dear students, in this model, no growth model, what is the formula? So EPS or DPS. EPS or DPS divided by net proceeds or market price. There is no difference between EPS or market price. So if you KE find it out, EPS or DPS divided by net proceeds or market price. If you want to find it out market price, EPS or DPS divided by KE, it is also called investor expected rate of return, or you can also say it is yield rate. Yield rate. So cost of equity equal to investor expected rate or yield rate. This is the model with respect to no growth model. What is the formula of no growth in EPS? No growth in dividend model. So KE equal to EPS or DPS divided by net proceeds or market price. Whereas market price equal to EPS or DPS divided by KE. Okay. Right, now we are going to discuss a no growth model problem. So dear students, once again I would like to tell you that no growth means no growth. Why no growth? Because company declares 100% dividend. When company declares 100% dividend, DPS or EPS both are same. So no retaining ratio, no rate of reinvestment, no growth rate. Okay, that is the reason. In this problem, we are going to calculate market price under constant growth rate model. Okay, no, sarala kaadu. In this model, we are going to calculate market price under no growth in dividend model. Okay, see, Mahindra is the shareholder in Central India Limited. He is a Mahindra, he is the shareholder of Central India Limited. Although earnings Central have varied considerably, it means the varying, right, considerably. Mahindra has determined that the long run average dividend for the firm is 2 per share. Long run it is going to give 2 rupees. It means that whether there is a growth or not. So every year dividend will increase, then there is a growth in dividend. But here it is saying in long run it will remain constant, means no growth. Okay. He expects similar pattern prevail in future. Long run 2 rupees, and even in future also it will happen same. Given volatility of central dividend, Mahindra has decided that minimum rate of return is 20%. So Mahindra's required rate of return, Mahindra's yield rate, this is also called KE. Just now I told you. So KE or yield rate or investor expected rate earn on this given investment. What price would be Mahindra willing to pay Central India? Actually in this problem they have to ask KE, but KE they have given, they are asking market price. Generally you see it in this problem, here you see it. Given information. What is the given information to you? What is the information given to you? Number 1, EPS is given. How much? 2 rupees, you see. EPS is 2 rupees. Got it? Then investor expected rate or yield rate or KE is how much? 20%. Market price we have to find it out. So generally market price equal to EPS or DPS divided by KE. So if you ask to find it out KE formula, KE equal to EPS or DPS divided by market price. But in this problem they asked us to find it out what market price. In this case market price equal to 2 divided by 20%. Calculate it please. 2 divided by 20%, that would be how much? 1, 2, 3, how much? 10 rupees. So this is the problem. So they have given KE and asked market price. If they would have given market price and we will calculate KE. So KE equal to EPS or DPS divided by market price. So this is with respect to no growth in dividend model, dear students. Next we will move into constant growth rate model. Constant growth rate in model. So constant growth rate in model, it is a model which indicates that this model is applicable for stable and standard earning companies. We will assume that the EBIT of the company will remain stable. Standard companies. Okay. Growth rate, how do you get the growth rate? Just now I told you growth rate is nothing but how much you are retaining, retained amount where you are reinvesting. So retaining ratio into rate of return on reinvestment is nothing but a growth rate. If you want to get highest growth rate, you have to do 2 things. Number 1, either you have to retain more amount or either you have to reinvest at a highest growth rate. So you have to consider this both, otherwise it would be difficult for you. Then constant, why it is constant it is said. So every year company constantly pays dividend given percentage. For example, 100 rupees. Company declares that 60% dividend payout ratio is a constant. then 40% reinvestment, 40% retaining ratio is also constant. It is assumed that when company able to generate same return, the company fixes dividend to payout ratio constant, makes a constant. So when dividend to payout ratio constant means retaining ratio also constant. So how much amount they will retain, they will reinvest in a given rate, right? Reinvestment. That reinvestment rate also constant. Why? Because if you go for highest risk, highest discounting rate, then risk would be highest for you. So that's why what company plans that it won't go high, it won't go low. By considering reasonable risk to be handled, reason risk to be calculated, it will fix a certain rate of reinvestment rate. Frankly, students, what I would like to say is, in this model, retaining ratio cum rate of reinvestment rate, both are constant, fixed, same. When both are same, with effect, growth rate also remain constant. In this model, every year, gradually, dividend growth rate increases at a given percentage. Constant growth rate model. As per this approach, dividend and growth rate remain constant. In this model, EPS is not DPS. Why? Because if you earn 100% EPS, out of this EPS, company declares some percentage dividend payout ratio and remaining declares retaining ratio. So that's why dividend per share is different from earning per share. At the same time, DPS not equal to DPS1. DPS1 means dividend to be paid at the end of the first year. Last year, how much dividend paid? So company will earn, company pay some growth rate on the dividend. That's why DPS 0 is different from DPS 1. DPS 1 is different from DPS 2. DPS 2 is different from DPS 3. Then what is the difference? Growth rate. So if I want to find it out, DPS 1, DPS 0 plus growth rate is nothing but DPS 1. So DPS 10 you want it, dividend to be paid at the end of the 10th year if you want it, then dividend to be paid at the end of 9th year plus growth rate would be DPS 10. So this would be for calculation, dear students. So KE equal to, in this model, how do you calculate KE is nothing but DPS 1, dividend to be paid, divided by net proceeds or market price plus growth rate. If DPS 1 is clearly mentioned, okay. If not, DPS 0, last year dividend plus growth rate. So KE equal to DPS 1 divided by net proceeds or market price plus growth rate. So in this model, they may ask you market price. You can separate the market price from here. Then market price equal to, you see it, you can analyze it. This growth rate if comes here, it would what happens? Plus, it will become a minus. So KE minus growth rate. Cross multiplication with MP, market price. Imagine the formula. DPS 1 divided by net proceeds or market price remain constant. So KE minus growth rate. KE minus growth rate. So KE also called yield rate or investor expected rate. So this is the formula to be estimated. So simply, what is the constant dividend growth model? Under this model, how much EPS earned by the company, instead of distributing that amount to equity shareholders, company retains certain percentage. It makes fixed, it is constant, and remaining percentage it pay to equity shareholders. So EPS is segregated into two categories: dividend payout ratio, retaining ratio. So how much funds company retains, it will reinvest at a given rate. It will reinvest at a given rate. So that rate also constant. Since retaining ratio constant, rate of reinvestment rate also constant, thus the company have wonderful growth rate. That growth rate remain constant over the period. So KE formula, DPS 1 divided by net proceeds or market price plus growth rate. Market price formula, DPS 1 divided by KE minus growth rate. So this is with respect to constant growth rate model. In our material, we have a problem, we will see constant growth rate model. In problem number 14 we can take it. In this problem, you should understand no growth and growth, both the models, right. Problem number 14. Yeah, this is the 14 in your material. Here I made it. This is 14 problem. See, XYZ Limited is currently earning profit after tax of 25,000. Profit after tax of 25,000. And its shares are quoted in the market 450 rupees. So what is the market price of the share is 450. The company has 1 lakh shares outstanding. How many shares they have? 1 lakh shares. And it needs capital structure. It is expected that same level of earning will be maintained. You see, same level of earnings to be maintained. So earning will remain constant. Okay, in future also. The company has 100% payout ratio. Yeah, I came to know that when company declares 100% payout ratio, then same level of earnings will be there, you know, that is a universal truth. Right, calculate cost of equity. This is the first part. Means when company declares 100% dividend payout ratio. If the company payout ratio is 70% and it earns 20% on rate of return on its investment, then what would be the firm's cost of equity? They asked 2 times cost of equity, cost of equity. In first option, company declares 100% dividend payout ratio. In second option, company declares only 75%, 70%. So what will happen? Okay. Let us discuss with the, once again, XYZ Limited. Currently earning profit, how much? 25 lakhs. 25 lakhs rupees they have a profit. So current market price is how much? 450. Currently number of equity shares, 1 lakh shares. See, 1 lakh shareholders has to distribute, 1 lakh equity shareholders can distribute 25 lakhs. That means the funds belongs to equity shareholders is 25 divided by 1 lakh. It's nothing but a 25 rupees per shareholder will get it. Do you agree? EPS is nothing but earning availability to equity shareholder divided by number of equity shares. So 25 lakhs profit got it, 1 lakh equity shareholders are there, then 25 rupees per share they will get it, right? So now company follows 100% dividend payout ratio. Tell me whether there is a growth or no? No growth. Why? Because how much dividend is earned? That dividend is exactly company pays to outside. Company pays 100%. In that case, no growth. So first situation is 100% dividend payout ratio. It means 0% retaining ratio. When 0% retaining ratio is there, even though company can generate 20% outside, company could not generate it because no retaining. No retaining ratio. Got my point, dear students? So in first option, how do you calculate cost of equity? Simple, sir. In 100% dividend they are declaring. In that case, EPS, DPS both are same. So company is not issuing now, but company already issued, market price is given 450 rupees. So in this case, EPS divided by market price into 100. That means 25 divided by 450 into 100. How much? 5.55%. That's, you got it here. Let us check the answer. This is part A. Working note 1. First of all, what you have to do? Estimation of earning per share. What you have to do is, you have to estimate earning per share. Okay. EPS equal to earnings availability to equity shareholder divided by number of equity shares. So 25 lakhs divided by, see, EPS equal to, how do you calculate EPS? This is the EPS. EPS equal to earning availability to equity shareholder divided by number of equity shares, dear students. So earning availability equity shares how much? 25 lakhs. So number of equity shareholder 1 lakh. So 25 lakhs divided by 1 lakh, you will get it 25 rupees. Got my point? Right. Now estimation of KE, you have to estimate it. You have estimation of KE. Estimation of KE. So KE formula, KE equal to EPS or DPS. Both are same. Why? Because company follows 100% dividend payout ratio. So EPS divided by market price. So 25 divided by 450 into 100. That you will get it 5.55%. So this is the answer I showed to you all here. Okay. For the time being, I prepared this PPT for you. This is first working note 1, estimate EPS, then calculate it. Coming to second point, what they given, if the dividend payout ratio is 70%, in that case what to do, sir? So company earned how much? 25 rupees, right? Do you agree, ma? Company earned how much? 25 rupees. Out of this 25, okay, 25 rupees is company earned. Out of this 25, 70% company is dividend payout, means 25 into 70%. 70%. 25 into dividend payout ratio 70%. That is 17.5 actually. Remaining retaining ratio is how much? 70% paying means 30% retaining. The 30% retaining, how much you are retaining? You reinvest at 20%. So 30%, 20%. Approximately you convert into decimals. 0.60 into 0.20. So you will get it 0.30 into 0.20, approximately 6%. That would be the growth rate. Then you can use the formula KE equal to DPS1 divided by market price or net proceeds plus growth rate. Let us check it. This is part B. Observe very carefully. Given information, this is a part B. Given information, EPS is how much? 25 rupees. How do you calculate? Earnings divided by number of equity shares. Okay. Dividend payout ratio how much? 70%. So dividend per share is how much then? 25 rupees EPS into 70%. 25 into 70%, you got it how much? 75 rupees is the dividend paid to the equity shareholder. Thereafter, retaining ratio, how much you are retaining? 30% you are retaining. So retaining 30%. What about the rate of reinvestment rate? 20%. Then growth rate formula. What is the growth rate formula? Retaining ratio into rate of reinvestment rate. Retaining ratio into rate of reinvestment rate. Retaining ratio 30, 0.30. Rate of reinvestment 0.20. 0.30 into 0.20. You will get it 6%. So this is the growth rate, you got it. You got it. So next step is growth rate. Once you estimated, you can calculate KE. What is the KE? KE equal to DPS1 divided by market price plus growth rate. Plus growth rate, because you retained it, right? You reinvested. For that you have to give a growth rate. So here 17.5 divided by 450 plus 0.06. That would be 9.89% of KE would be there. So this is the way to find it out. Once again, you check it. Part A, estimation of KE when there is no retaining ratio, 100% dividend payout ratio. In that case, KE equal to EPS divided by market price. Whereas when company retains 70%, 70% means dividend payout ratio, 70% dividend payout ratio, 30% retaining ratio. 30 into 20, you will get the 6%. Okay. Whereas here dividend to payout ratio 70% means 25 rupees of EPS into 70, 17.5 you will get it. So market price, however they have given, that is nothing but 450. Now you can calculate the KE. KE equal to DPS1 divided by market price plus growth rate. DPS1 25 into 70%, 17.5. Market price is given. Growth rate, retaining ratio into rate of reinvestment rate, 0.30 into 0.20, that is nothing but 6%. Finally, so 17.5 divided by 450 into 100 plus this is 6%. In total 9.89%. This would be the answer for you. Got it? Right. So with this cost of equity under no growth and constant growth rate we completed. Okay. Thereafter you have one more model, that is realized yield approach. So thereafter you have a earning price approach. What is the earning price approach? So earning price approach is this approach, the KE of the company is estimated on what is that? Earning per share. So whether in this model, whether the company distributed dividend or not, that doesn't make any sense. How much of earnings they made it, because equity shareholders of the owners of the company, whether you distribute the dividend or not to distribute the dividend, that doesn't make any sense. That doesn't make any sense. Okay. So such an approach is called earning price approach. Here you have two models. One is earnings when EPS is constant, when EPS has a growth. So we in order to make you to better understanding, I will take problem number 17. So now we are going to take the problem number 17 from the dividend model. So in this model, I am going to solve the problem with respect to earning price ratio as well as earning price plus growth rate model. Got my point, dear students? Okay. From the following information, calculate cost of equity according to earning price approach. Earning price approach and earning price plus growth approach. Earning price approach, earning price growth approach. Current market price is how much? 100 rupees. Market price is 100. Expected earning per share 6 rupees. Growth rate is 6%. So current market price is 100. Expected earning per share is 10. Growth rate is 6%. Now, how do you calculate earning price approach? So earning price approach, no growth in approach, both are same. In this case, how do you do this? So earning price approach, what it conveys that irrespective of payment of dividend, they won't consider the cost. How much company earned, that would be the cost. Why? Because equity shareholders of owners of the company. Either you pay or not to pay, that doesn't make any sense. In this case, you see it, how much, how to calculate this one. Here, market price equal to earning price equal to C. KE under no growth model, under no growth model, no growth in EPS model. What to do? KE equal to EPS divided by market price into 100. How much EPS? 10 rupees. How much market price? 100 into 100. That equal to 10%. Got the point? Here they have given 10%. Exactly answer matched. This is under no growth model. By chance, if growth rate model is given, growth is given, in that case, how do you estimate? So, estimation of KE under constant growth rate model. Rate in dividend model. Constant growth rate in dividend model. In this case, what you do is KE equal to EPS divided by market price plus growth rate. EPS is how much? 10 rupees. Market price 100. That means 10 divided by 100. 10% you got it. Plus growth rate percentage 0.06. However, you have to multiply with 100, you will get it 16%. So, here the answer 10 divided by 10 into 100, 10%, that is a 6%. So, total you will get it. So, this is the model with respect to, what is that? No growth in dividend, no growth in EPS and growth in EPS model. Okay, right. So, next model we are going to discuss a realized yield approach. What is that? Realized yield approach. So, realized yield approach, this approach what it conveys that instead of thinking about how much cost we paid, we estimate the KE, how much our investor or equity shareholders earned. Dear students, let us suppose, imagine, I purchased SBA shares, I hold for 1 year, I sold it. During the 1 year, I got the dividend. At the end of the period, I sold the shares, I got the capital gain, because let us imagine I purchased for 50. I sold for 60, 10 rupees I got the gain there, 6 rupees dividend I got there. Over my investment, I got the 2 incomes with respect to 1 year. So, as a financial manager, this 1 year, how much equity shareholders earned? How much he earned? That is nothing but his rate of return, his IRR. What company believes that that man earned this much, I paid this much? In English, there is a saying, tell me about stupidity of your friend, I will tell you how stupid you are. Why? Because you yourself is, you are saying that your friend. So, that is the logic behind this technique. But sir, if I hold more than 1 year, in that case what happened? In that case, you have to calculate IRR technique. Why? Because I purchased today share, I spent 100 rupees. I hold the share more 5 years. 5 years I got the dividend, So, first year dividend, second year, third year, fourth year, fifth year, take the dividend. At the end of 5th year, if you sell the shares, so how much gain you got it, that at the end of the period you sold it, means similar to capital budgeting, If you make investment in the beginning, over the period operating cash inflow, at the end of the period terminal cash inflow, you will get it. The same logic you can apply here also. So, in this realized yield approach with respect to holding share for 1 year, let us take. See, according to this approach, KE of the company depends upon return earned by the equity shareholders, not company paid cost. It won't consider it. This is nothing but how much return he is supposed to be earned. So, he is earning this much, thus I paid this much. So, cost of equity equal to total yield or return on equity shareholders. This would be how much yield he made it, how much earnings he made it, that would be the KE. Here you see, realized yield approach, if you hold share for only 1 year, in this case 1 year you hold means whatever the earnings, what is the earnings you will get it. So, in realized yield approach, holds how much earnings he will get it. That is the point. For example, realized yield approach, he holds for 1 year. If you holds for 1 year, in this 1 year he will get the dividend, right? So, dividend yield you calculate. Dividend yield equal to how much investment you made it with respect to how much dividend you got it. So, DPS1 divided by market price. This is called a dividend yield. Whereas, at the end of the period you may sell the share, In this case, what happen? You may get the capital gain. So, capital gain is the difference between purchasing and selling price. At what rate you buy the share, purchase the share, at what rate you are selling the share, how much of amount you got it. So, for investment, how much return you generated. That is capital gain yield. Capital gain equal to market price 1, market price 0 divided by market price 0. So, in this case, you will get the capital gain yield. Now, total yield you make it. Total yield is nothing but dividend yield plus capital gain yield. If you add it both, you will get the total yield. You can also use this formula. Total yield equal to DPS1 plus market price minus MP0 divided by MP0. So, this is also one of the technique to be estimated to calculate KE. So, realized yield approach, it conveys that if 1 year, direct formula. If more than 1 year is there, in that case we will go for what? IRR technique. In this IRR, beginning, how much investor invested. Number 2, given how many years you hold the shares, that concern year dividend. At the end of the period, net sale proceeds. Considering this cash inflow, cash outflow, we can calculate KE. Either 1 year or 2 years, how much yield, a return earned by the equity shareholders, that would be considered as KE. Okay. Let us imagine we will take a problem number 18. Here I prepared the PPT, here I took the 18 number, but our regular batch in realized yield approach, I will take one problem which is given in your material. 18th problem, 18th problem I discussed with. Problem number 18, in this problem I am going to give a demonstration on how realized yield approach works. Okay. A share is selling at 50, which dividend 3 per share is expected at the end of the year. The expected market price after dividend declaration is 60. After dividend declaration is 60. He purchased actually for 50. He sold this share at the end of the first year for 60. He got the gain of 10 rupees. Whereas company paid a dividend 3 rupees. So, return on investment, he asking that what is the total return on investment, what is the dividend yield, what is the capital gain yield. He is holding 1 year. In this case, dividend yield, how much you got it, how do you calculate dividend, how much dividend he earned for his investment. So, dividend divided by investment, 3 rupees divided by 50. So, 3 divided by 50 into 100, that is 6%. Dividend yield, he got the 6%. Capital gain, for the sake of 50, he got the 10. 10 divided by 50 into 100. 10 divided by 50 into 100, 20%. 20%. This is dividend yield, this is capital gain yield. If you add both, 26% would be the total yield. I will give you a small presentation for this. You see, given information, what is the market price? 50 rupees. What is the dividend? 3 rupees. Market price after declaration of dividend, how much? 60 rupees. Okay. Estimation of dividend yield. How do you calculate dividend yield? Dividend yield equal to, what is the formula? dividend equal to dividend divided by market price into 100. Dividend divided by market price into 100, that 3 rupees divided by 50 into 100, you got the 6%. Thereafter, estimation of capital gain yield, capital gain yield. So, estimation of capital gain yield equal to market price 1 minus market price 0. Market price 1 minus market price 0. At what rate you purchased, at what rate you are selling it. So, MP1 minus MP0 divided by MP0 into 100. 60 rupees you purchased, 50 rupees you are selling, 10 rupees you got the gain. So, 10 divided by 50 into 100, you got the 20%. Now, estimation of total yield or total return on investment. So, total yield equal to dividend yield plus capital gain yield. Dividend yield plus capital gain yield. This is dividend yield is 6% plus capital gain yield 20%, that equal to 26%. Or you can use this formula also directly. Dividend yield equal to DPS1 plus MP1 minus MP0 divided by MP0. Here the bracket must be there. Here I showed it, here I forgotten to put it this. So, DPS1, how much dividend they paid? 3 plus 60 minus 50 divided by 50. You will get it how much? 26 would be, you will get it this one. Here 3 divided by 6%, you know, it's not 3%. 6%, 6 plus 10 divided by 50, that is nothing but you will get it at 20%. DPS1 dividend actually, no, it's right only ma, it's not EPS please. 3 divided by dividend, 3 divided by 3 plus 60 minus 50 divided by 50 into 100, 26%. So, this is the way to analyze dividend yield approach. With this, dividend debenture KE finished, market KP finished, KE under, no growth in dividend, constant growth rate in dividend, EPS model. Another one is total yield approach. Next you have CAPM approach. This is capital asset pricing model. See, with this maximum we can understand the KE techniques, then we will enter into the weighted average cost of capital. Capital asset pricing model. Capital asset pricing model was proposed by Sharpe in the year 1961. Mr. Sharpe analysis is very short. What Sharpe argues that KE of the company related with risk associated with the company. You see the elephant here walking on a rope means taking much risk. It is coming from one point to another point. The point at which it reaches, there it should get the best benefit. That's why it's taking a risk. So, KE of the company depends upon risk associated with the company. Risk associated with the company. More risk, more cost to be paid by the company. Here, the point is, there are two types of risk you can estimate. Capital asset pricing model. This theory was suggested by Sharpe. This model describes the risk return trade-off between risk return trade-off of the company. How much risk is there? He has to get that proportionate of return for that. So, here risk of the company being classified into two types. One is unsystematic risk, another one is systematic risk. Unsystematic risk, you can also call the diversifiable risk, another one is non-diversifiable risk. So, diversifiable risk, unsystematic risk also called diversifiable risk. So, risk can be diversified. See, when risk is diversified, all the people all with the proper portfolio, how investment making a portfolio, how we will reduce the risk. At the same time, with the proper analysis, we can mitigate the risk. Since risk can be mitigated, unsystematic risk is eliminated. So, CAPM approach is purely related to systematic risk. What do you mean by systematic risk? The risk associated with any company, you see, systematic risk, the total risk of the business being classified into two types. One is unsystematic risk, which is called diversifiable risk. which can be controllable, thus it is called not risk. It is not at all called a risk. Why, sir? Because in a business, chances are there to get a loss. So we will identify why there will be a loss. Because sales are not good. Why the sales are not good? Marketing is not good. So by taking proper precautionary steps with respect to marketing, you can control that one. So any risk which can be managed, which can be controllable, which can be analyzed, such a risk is called unsystematic risk, which is called diversifiable risk. Diversifiable risk can be controlled, thus it is not at all risk. No need to get more return for risk taking. That is the SCMPE theme with respect to unsystematic risk. But he is also projected systematic risk. Systematic risk also called non-diversifiable risk. What? Non-diversifiable. You cannot diversify it. You have to face it exactly. So the risk of the company not depends upon internal factors but depends upon external factors. Such a risk is called non-diversifiable risk, or which is called systematic risk. For example, which cannot be controlled. Example, environmental factors, tsunami, change in dollar value, change in interest rate, coronavirus. Okay, all this comes under non-diversifiable risk, which can also be called beta. If more beta is there, more systematic risk is there. In that case, the equity shareholders has to get more return. What this concept explains that the highest risk premium must be expected by taking risk. For example, an investor is there, okay, without taking risk by going and depositing in a bank, he will generate 18%. But whereas this man, instead of investing in bank, he wants to make at HDFC, he wants to make at Infosys. Infosys is there. So if he makes investment in Infosys, he should not get 18%, because without risk he is getting 18%. Here plus he has to get plus, that plus is nothing but risk premium for taking risk. This risk premium depends upon how much of non-diversifiable risk Infosys will face it. That would be considered. So the risk associated with Infosys because of some external factors like dollar, so far I said, because of that factors, how much risk it's supposed to face it. That could be measured in beta. Beta would be three conditions: equal to 1, greater than 1, less than 1. When beta is more than 1, it means that it is the highest risky facing. It is in highest risky zone. So then it has to get more risk premium. When beta is less than 1, in that case, less than 1 means in that case risk is very less, so risk premium also nominal. Equal to 1 means normal. So keeping in this point, CAPM approach has made such a analysis like this. You see it. According to CAPM approach, KE of the company equal to risk-free rate. Risk-free rate he has to earn plus risk premium. So you see how this formula is developed. So this is RM, means return on market portfolio, the total return, consider total return. From that you already given risk-free rate. Total return minus RF, risk-free rate has gone. So total return consists of two rates, risk premium, risk-free rate. This is called RM. Out of this RM you have given RF. So what is left to you? Risk premium left to you, RP. So this risk premium depends upon the beta. As beta increases, risk premium also increases. You see this formula. This is risk-free rate. Equity shareholders has to get the risk-free rate plus risk premium. So here risk premium, how do you get it? RM, return on, total return on market portfolio minus RF. From RM, deduct RF, multiply with the beta. If beta is high, risk premium should be high. If beta is less, risk premium also low. So this is the model KE equal to RF plus beta into RM minus RF. I completed capital asset pricing model. So capital asset pricing model is one of the technique used to evaluate cost of equity. This technique guides you. The equity shareholders who invest in your company must get two returns, two way of returns. One is risk-free rate, another one is risk premium. So here the risk is nothing but systematic risk, which is termed to be beta. Beta might be in three ways. One is more than 1, less than 1, equal to 1. As per beta, risk must be evaluated. Basing on that risk premium should be given. Yesterday I told you the formula for cost of equity estimation with respect to beta, where KE equal to RF plus beta into RM minus RF. So beta is not related to diversifiable risk, whereas it related to non-diversifiable risk. So whenever you are going to calculate weighted average cost of capital, certainly you should estimate specific cost. So this specific cost may be calculated basing on dividend, EPS, total yield or CAPM approach. So that is the reason why we discussed this topic, where KE equal to RF plus beta into RM minus RF. The next topic with respect to this is cost of retained earnings. If you observe our material, okay, if you take our material, the next topic is cost of retained earnings. So what is the retained earnings? How the cost is estimated? If this topic is over, so completely estimation of specific cost discussion would be finished, right? Retained earnings. What are the retained earnings? Dear students, retained earnings are, retained earnings are funds belongs to equity shareholders. So equity shareholders invest in any company. With that amount, the company invests somewhere else, or company start to do business. From this business aspect, company generates certain profit. Actually, after deducting all this expenses, some profit left to the company that should be distributed to equity shareholders. But the company will have a doubt that if we distribute this funds to equity shareholders, by chance, if company dire need of funds or company require some additional funds for the sake of any investment, in order to handle uncertainty, in order to handle good investment opportunities outside, in this case, company sometimes may retain the profit belongs to whom? Equity shareholders. Instead of distributing equity shareholders, company sometimes retain the funds. Such earnings are called retained earnings. So retained earnings are undistributed profits belongs to equity shareholders. So this is the purest income belongs to equity shareholders. If company retains the retained earnings, should the company pay cost to equity shareholders? If this is the question, the straight answer is yes, because if you distribute retained earnings to equity shareholders in the form of dividend, their people might invest outside, If they invest outside, they will get certain benefit, they would get certain benefit. So when company retains that funds, what happen? Equity shareholder forgo that benefit. That is called forgo that benefit. So that's the reason the company has to pay cost for retained earnings. So there are two approaches generally used for estimation of cost for retained earnings. Okay. Point number one, what I discussed, what is the retained earnings? When, at what time, at what situation company wants to retain or company retains the funds of equity shareholders. If company retains the equity shareholder funds, so what is the impact on equity shareholders income? Okay, these are the topics just now I discussed with you. Now I am going to tell you that what are the approaches or methods which are available to calculate cost of retained earnings. There are two techniques generally used. Number one is retained earnings or funds belongs to equity shareholders. Okay, that's why without calculating, without using any method, any approach, blindly you can come to conclusion retained earnings or funds belongs to equity shareholders. So KR equal to KE. That's enough. That's enough. KR equal to KE. But the point is, when you are estimating cost of retained earnings, you must keep it on point. That is, when you are saying KR equal to KE, but KE is generally issued. Means KE means the cost of equity to be paid to the equity shareholders. How it is to be estimated? We will calculate a par, premium, discount and everything. So dear students, when cost of equity is calculated, flotation cost is considered. Why? Because without issuing equity shares, you cannot get the equity funds. That's why in cost of equity, flotation cost exists. But in retained earnings, flotation cost doesn't exist. That's why what I would like to convey to you, all the people, whenever you have to calculate cost of retained earnings, simply you may assume that retained earnings are funds belongs to equity shareholders. So that's why KR equal to KE. But that KE should not include flotation cost. Why? Because a retained earnings doesn't consist of flotation cost. That's why KR equal to KE, but it should not consist flotation cost. That should be most important point. That is the first approach. Second approach means you have to find it out what is the opportunity cost benefit equity shareholders forgo if company could not pay a dividend or his earnings to equity shareholders. For example, I am an equity shareholder. I'm a financial manager. Let's assume there are outside of this campus my equity shareholders are there. I retain their funds. I want to retain their funds. I call them and I ask them, I am going to retain your funds, man. I will ready to pay cost on these funds. So tell me how much you need. So they people said, sir, if we would have invested in outside or other states, or let us take it in Chennai. If we invest in Chennai, we will get a 20%, sir. So we are ready to allow you to retain our funds, but you please pay that 20%. Why? Because we are losing the opportunity cost. Yes. If the discussion starts between us, in that case, I will consider that 20% is the equity shareholders expecting. Why? Because if they would invest outside, they will get 20%. That is their net opportunity cost benefit. Okay. But what I finally conclude that from that net opportunity, I will find it out ultimately how much they are going to generate. Ultimately, it means that what's it? For example, these people would have invested in Chennai, they will get a 20%. But from Andhra to going to Chennai, they will incur certain transportation expenses, some brokerage, some other things will be there, So I will deduct that tax, I will deduct that expenses. If whatever the profit they will earn in outside, if that profit is eligible to pay tax, after deducting that tax amount, how much post-tax net opportunity they used to get it, I will pay that one. So as a financial manager, you have to consider all these things. So net opportunity cost loss suffered by or missed by equity shareholders, that should be paid. That should be paid to whom? Equity shareholders. So that is the reason here I have taken a formula, you check it here. First approach, cost of retained earnings, KR equal to cost of equity shares. But the point is, it should not consider flotation cost. That is the point number one. Point number two, retained earnings means investor expected rate. But out of that, brokerage will go. Out of that, tax rate will go. So cost of retained earnings KR equal to investor expected rate minus brokerage into 1 minus tax rate. Let us take a small problem, we do it in this. Y limited in your material is there, this problem in our 43 edition number retained earnings from one model, I will say problem number 21. Problem number 21. You see, Y limited retained 7,50,000. I am Y limited. Let us imagine. I am going to retain the funds of whom? Equity shareholders. The expected rate of return, if they would have invested outside, they will get a 10%. The brokerage is 3% and the shareholder come 30% tax bracket. Calculate cost of retained earnings. So this is the point. How do you calculate? Let us say equity Y limited is retaining the funds. How much? 7,50,000. Because of retaining their funds, so equity shareholders will lose opportunity cost. So if they would have invested outside, they will lose 10%. They will lose 10%. That's the point they are considering. But as a manager, I know that they won't get a 10%. Why? Because brokerage 3% goes and tax 30% goes out. So after deducting all these things, how much net benefit the equity shareholders forgo because of retaining their funds, I ready to pay that amount. This is the way you have to find it out. Let us take here. So this is a problem 21. Investor expected rate 10%. Brokerage how much? 3%. shareholders tax how much? 30%. Okay, that is nothing but personal tax. Where they will earn the money, that amount is eligible for paying of tax. That tax is 30% here. It's not a company's income tax. Okay, now here the point is cost of retained earnings equal to, how do you calculate? Investor expected rate, you will expect 10%. Okay, but out of this 10%, the brokerage, the investment charges, 3% goes out. Thereafter, means from 10 there would be a 3% brokerage goes out. After going that, how much profit he will generate, from that 30% tax rate goes out. Okay, that's why 10 into 1 minus 0.3 brokerage and into 1 minus tax rate 0.30. So how do you calculate? 0.10 into 93% into 70% into 100. You can take it. So 6.79% you will get it. 10 into 1 minus 0.10 into 1 minus 0. Into 1 minus 0.30, you will get it 6.79%. That's enough. So wonderful to calculate. This is very simple technique to be used. So this is the net opportunity the equity shareholders will earn by investing these funds outside. So as a manager, what I will say, I will invite the equity shareholders, I will tell them that okay, I agree that you will earn 10% outside, but what about the brokerage? What about the tax rate? After deducting everything, 6.79% of net amount you will earn outside by investing my earnings. So as a manager, I will pay that amount. So you will allow me to return your funds in our company itself. So certainly they will accept. So this is the way to find it out, retained earnings. Ultimate point, unforgettable point is, dear students, cost of retained earnings arises only for existing companies, not for new companies. That companies that must be existed, and at the same time that the track record must be good. When the company earns profit, then only this topic will come. Okay, so with this we discussed with all the concepts of cost of debt and cost of equity, cost of preference, everything. The dear students, first what I discussed with you, cost of debt I discussed with you. Yes or no? Cost of debt. So I discussed redeemable, irredeemable. I explained the future irredeemable debenture, 1 minus tax rate, cost of debenture, interest into 1 minus tax rate. Thereafter I discussed with you redeemable debentures. Redeemable debentures, shortcut method, IRR technique. When flotation cost exists, tax exists, advisable to go with company point of view. Thereafter I discussed with investors point of view. Then I discussed with you is cost of preference. So cost of preference is similar to cost of debt. I discussed with you cost of preference. There also I discussed the cost of irredeemable preference shares. Irredeemable preference shares, preference dividend into 1 minus dividend distribution tax divided by net proceeds or market price. Thereafter I discussed with you redeemable preference shares, where shortcut method also you can use it. So cost of preference equal to preference dividend plus redeemable value minus net proceeds divided by N whole divided by RV plus NP divided by 2. Whereas if it is a redeemable, you can use it IRR technique, IRR from investor point of view or company point of view. The two things are finished. Thereafter we discussed a KE. Cost of equity can be estimated from dividend price approach, earning price approach, realized yield approach, capital asset pricing approach. And I explained clearly, dividend price approach you have no growth, and then you have constant growth rate in dividend. Thereafter EPS, no growth in EPS and constant growth in EPS. Thereafter total yield, thereafter CAPM approach. First no growth model I discussed with you. When company declares 100% dividend payout ratio, there is no difference between EPS and market price. When company declares 100% dividend payout ratio, there is no chance for retained earning, hence there is no growth rate. In this model, what is the formula of KE? KE equal to EPS or DPS divided by market price. Whereas market price equal to EPS or DPS divided by KE. Thereafter, I discussed with you constant growth rate model, where growth rate constantly moves. Constant growth rate model. This model is applicable for stable and standard earning companies. where growth rate equal to retaining ratio into rate of reinvestment. Okay, retaining ratio is constant, rate of reinvestment also constant, hence growth rate also constant. In this model, EPS is not equal to DPS, DPS 1 equal to DPS 0 into 1 plus growth rate. So KE equal to DPS 1 divided by net proceeds or market price plus growth rate, where market price equal to DPS 1 divided by KE minus growth rate. So KE also called yield rate or investor expected rate. So thereafter we discussed earning price approach. Earning price approach, in this approach KE is estimated from earnings point of view, EPS point of view, not dividend distribution point of view. In this, no growth in EPS, KE equal to EPS divided by net proceeds or market price, where growth rate in EPS equal to KE equal to EPS divided by net proceeds or market price plus growth rate. So for this also we discussed a formula. Thereafter EPS is finished. Thereafter I discussed with you total yield, yield based. Yield is nothing but earnings, earnings made by the equity shareholders. How much earnings made by the equity shareholders, that would be the cost of equity. This is one approach. But here the point is, realized approach is nothing but basing on earnings only, cost of equity is estimated. But when equity shareholders purchase the shares, how long he will hold it? If he holds for only 1 year, then realized yield approach would be used. 1 year he holds means he will get two types of income. Dividend yield, where DPS 1 divided by market price. Thereafter capital gain yield, he will get a market price. Capital gain yield means the difference between the purchased price and sold price of equity shares, where capital gain equal to dividend yield plus capital gain yield, where total yield, this formula also you can convey like this: DPS 1 plus market price MP1 minus MP0 divided by MP0. Thereafter, if you holds more than 1 year, sir, then in this case you have to go for IRR. Okay, IRR, where more than 1 year means you will generate an IRR, that IRR would be cost. Then thereafter, realized yield approach, thereafter I discussed with you CAPM approach. CAPM approach, where the CAPM approach conveys that KE of the company depends upon risk associated with the company. Risk associated with the company. The risk being classified into two types. One is diversible risk, non-diversible risk. Non-diversible risk also called systematic risk, which is considered as a beta. Okay. So this method conveys that KE of the company should depends upon risk-free rate plus risk premium. More beta, more risk premium and more KE. Thereafter we discussed cost of retained earnings. Retained earnings or funds belongs to equity shareholder. This can be estimated by two ways. One is assuming KR equal to KE, another one is finding net opportunity cost of equity shareholders. So this is, dear students, with respect to specific cost. Now we will enter into the weighted average cost of capital. So for the examination point of view, weighted average cost of capital only, but without knowing specific cost, how do you do weighted average cost? So what is a weighted average cost? It is a systematic summation of all the specific costs. What are they? KE, KD, KP, KR, all these things. All the specific cost summation itself is called what? Weighted average cost of capital. It is also called overall cost of capital. So these are the various different sources, specific cost combination. So weighted average cost depends upon the capital structure of the company. For example, if company goes with 100% equity, in that case KO is nothing but KE, both are same only, right? So how do you calculate this weighted average cost of capital? To calculate weighted average cost of capital, there are two major steps involved. Step 1, you have to estimate specific cost, KE, KD, KP, KR, all these things. Another one is you have to make summation of all these costs, right? The steps to calculate weighted average cost of capital includes two. One is a proportionate method, another one is a product method. Proportionate method, what you do is, we will find it out each, for example, you raised a capital from various sources. You have a equity, you have a preference, you have a debt. From the total, try to find it out what would be the equity proportion and multiply with its cost. You will get the cost for this equity proportion. From the total capital, take the preference proportion and multiply with its cost. You will get this proportion, preference proportion. And like that, debenture, from the total capital, take the debenture proportion, multiply with the specific cost of debt, you will get the total. So you sum it up 1 plus 2 plus 3, you will get it the proportionate method weighted average cost of capital. For example, you see from total capital equity proportion, I took it, you may take it as a, you may call it as a weights, or I may say as a proportion. When the total, how much the equity proportion, and multiply with its specific cost, plus make it add. From total capital employed, what is the proportionate of preference? Take this one, multiply with cost of preference, plus debentures are there. From total capital employed, so debt to capital is how much? Okay, multiply with cost of debt, plus from total capital employed, how much retained earnings are there? Multiply with. So this is very fastest way to find it out, cost of equity. So each source proportion or weight from the total capital employed, multiply with its specific cost, you will get it weighted average cost of capital. This is a proportionate method. Whereas product method means what you do is you will take each and every source and you will start to multiplying with that cost. Okay, product method, what we will find it out is for equity 10 lakhs. For example, in product method, what we do, we will take a source. Let us take here. You keep this one outside. You will take source. How much cost would be there? Equity, preference, debentures. Equity, preference, debentures. So take its amount. How much amount should be there? Equity, how much you are raising? 50 lakhs, 40 lakhs, 30 lakhs. And take a specific cost. 14%, preference 12%, debt 10%. For 50 lakhs, you have to pay 14%. What would be the cost? Take this. For preference, 40 lakhs, 12%. How much the cost? For 30 lakhs, 10%. How much the cost? You find it out the total cost to be paid for rising of this 50, 40, 90, 90 plus 30, 120 lakhs. For 120 lakhs, you have to pay this much of cost. For 100, how much you have to pay? For 100, how much you have to pay? That would be the proportionate for this cost. Okay, let me give you a small clarity for this one for better understanding. Okay, here there is a company called my own company. Let us assume ABC company. The equity shareholders is 40 lakhs. The cost of equity is 14%. For preference shareholders, 20 lakhs, 20 lakhs, 20 lakhs. The cost of preference would be, this is cost of preference would be 12%. Here it is, cost of equity is 14%, whereas debt is 50 lakhs. So cost of debt is 50 lakh, 10% you have to pay. Retained earnings KR 20 lakhs into 30%. Now we have to calculate weighted average cost of capital. Let us assume in proportionate method, just now what I told you. So from the total capital employed, proposed equity proportion and multiply with KE. From again preference, total capital employed, preference share capital multiplied with KP and add back to it. Thereafter total capital employed, debt to capital, multiply with specific cost, add to existing sources cost, retained earnings. Like that, you see here for equity 14%. What is the total capital employed? 50 plus 40, 90, 90 plus 10, 110, 110 plus 20, 130. Here I have taken, this is not 130, 150. 40, yeah, 130. So you may change the proportionate, 40 plus 60. This may be retained earnings 20, 40, 20, 20, 20, it may be 130, 130 proportionate value. By taking this proportionate, you can calculate in this way. And at the same time, if you want to find it out, there it is wrong actually, 130, here I have said 130, not 150 please. So proportionate method you can take it. Here also you see 40 plus 14%, this much of product. 20 plus 12%, this is the product. 50 at 10%, this is the product. 20 plus 13, this is the product. Product method, product is multiplication. So for this amount you have to pay this much of cost. For this much of cost you have to pay. In total 130 lakhs, how much you have to pay cost? If you convert into percentage, you will get it. So this is the both the ways, proportionate method, product method. In this way we used to calculate weighted average cost of capital. Okay dear students. So now practically we will enter into our CA Institute 49th batch problem number. We will enter into the problem number, that is a problem number 1, which deals with the book value, market value problem. The first problem would be good comparing to this one from examination point of view. Okay. So in this problem, I will make you to understand what is the cost of capital and the marginal cost of capital. Second problem, I will discuss with you book value and market value. In this weighted average cost of capital, marginal cost. Second option, weighted average cost of capital basing on book value and market value. Let us take problem number 23. Dear students, now we are going to discuss the weighted average cost of capital. From the examination point of view, these models are very important. So far I discussed the specific cost. In order to calculate this weighted average cost only, I discussed with you. Let us work it out very carefully. So examination point of view, 10 marks you will get it this model. Okay. First model, past exam question paper it is, and new study material is there, old study material is there. So in 2019 MTP it is also given. So problem number 23, 43 addition problem. TA Limited the following capital structure. Equity share capital 2 lakhs, 40 lakhs each. So 2 lakhs, 40 lakhs, 2 lakh shares. Total capital 40. 10% preference share capital 10 lakhs. 14% debentures 30 lakhs. Total capital employed 40 plus 10 50, 50 plus 30 80 lakhs. So this is the total capital employed present. The shares of the company sells for 20 rupees. The market price of share is 20 rupees. It is expected that the company will pay next year dividend 2 per share, which will grow 7% forever. Assume 50% tax rate. Compute weighted average cost of capital based on existing capital structure. Existing capital structure. So dear students, first part A we will discuss, then we will come to part B. In part A, what's the topics they have given to you is specific cost you have to calculate first of all. Problem number 23. This model is weighted average cost of capital and marginal cost of capital. What we will learn? We will learn weighted average cost of capital and marginal cost of capital we are supposed to learn. Let us take, dear students, what you have to understand in this problem is, first of all, step 1, estimation of specific cost. Specific cost of each of the sources. Each of the sources specific cost you have to find it out. What are the various each of the sources which are available in the problem? First of all, point A, cost of equity. So what is a given cost of equity? A, market price is given to you. How much? 20 rupees is the market price. Next, growth rate also given to you. How much? 7%. Expected dividend, already they said that DPS 1 is given to you. DPS 1 is how much? 2 rupees they have given to you. From this data you have to calculate KE. So which model it will come? Constant growth rate model, because growth rate is there, you know. So that's why what you do is calculate KE. KE equal to DPS 1, okay, divided by market price plus growth rate. KE equal to DPS 1 divided by market price plus growth rate. Now post the values and find it out how much you used to get it. Here KE equal to DPS 1, how much? 2 rupees divided by market price 20 plus growth rate. Always show growth rate in decimals itself, because finally you have to multiply with 100 because you want to convey at a percentage. That is 0.07. So thus KE equal to, calculate it without mistake, 2 divided by 20 plus 0.07 into 100, that equal to 17%. So 17% would be the KE. First part is completed with respect to specific cost of equity. Thereafter, what is left to you is the first part, not first part actually, first concept, that is with respect to cost of equity we completed. Next you have cost of preference. The cost of preference. Preference capital, share capital can be estimated on redeemable based, irredeemable based. But in this problem, there is no any information with respect to cost of preference. Whereas in this case, what we say, cost of preference equal to coupon rate of preference dividend. That equal to, how much the coupon rate of preference dividend given is? 10%, I think. Right. Okay. Thereafter, with this we completed cost of preference. Then there is one more point, cost of debt. Cost of debt. Cost of debt, there is two things which are given. Generally, coupon rate of interest. Coupon rate of interest. That equal to coupon rate of interest is 14%. Then tax rate is given. Tax rate is given, that is nothing but 50%. 50%. Dear students, nothing is mentioned. In that case, coupon rate, cost of debt, both are same only. Okay. But in this problem, you got the tax. That's why cost of debt equal to interest into, this is the pre-tax is the coupon rate, convert into post-tax. Used to get the tax advantage. That equal to 14% into 14 into 1 minus 0.50, that equal to 7%. This is with respect to estimation of cost of preference and cost of debt, specific cost. This is the step number 1. Now we have to do is step number 2. What is the step number 2? Estimation of weighted average cost of capital, or KO. Estimation of weighted average cost of capital, or KO. KO is nothing but overall cost of capital. So what to do here? You have to sum it up each and every specific cost in such a way that you will get overall cost of capital. So I told you that how many methods are there? 2 methods. Either support of proportionate method or product method also, you can go with that. So I will always prefer you to take proportionate method because your time would be saved out. So here weighted average cost of capital for proportionate method, what is the formula I told you? So KE proportionate into specific cost. From that, equity share capital divided by total capital employed. From the total capital employed, how much the equity share capital? Take proportionate multiplied with the specific cost, plus KP into preference share capital divided by total capital employed, plus KD is there. KD equal to debt capital divided by total capital employed. This is the proportionate value, you can take it. Now post the values. What are the values in this given to you is, dear students? What are the values? KE, how much the KE? Just we calculated, right? KE is 17%. So 17% into, what is the total capital employed? Equity, how much the total capital employed? I think 80, I think so, right? 80. Yeah, this is 80. 40, 10, 30. Preference 10, 30. So, equity 40 divided by 80. Then preference specific cost we estimated. Preference how much? 10%, right? So 10% into 10 divided by 80 plus cost of debt we calculated how much? 7%. So 7% into 30 divided by 80. Got it my point? Right. Now you simplify this value. So 40 divided by, see, 40 divided by 80 into 17%. You will get it for decimals point of view, I am saying 0.085 plus. You can directly also calculate, no problem. 10 divided by 80 into 10%. It would be 0.0125 plus 30 divided by 80 into 7%. You will get it 0.02625. Now everything should be converted into percentage, 0.085 plus 0.0125 plus 0.02625 into 100. You will get it 12.375. Instead of doing this directly, you can calculate it. If I am the student preparing for exam, I won't write like this. Directly I will calculate it. But I am a teacher. I am teaching now. That's why I would like to convey to you all how to do this. Directly also you can do it. No problem. So dear students, while making this analysis, we will get it a weighted average cost of capital is nothing but 12.375%. So this is the way. Got the answer? How I calculated? Yes or no? So this is the way you have to find it out answer. First of all, you have to estimate specific cost. Then you have to calculate weighted average cost of capital. Okay? That's. So with this weighted average cost of capital, topic is over. Next, I am going to discuss marginal cost of capital. Marginal cost of capital. Marginal cost of capital. Dear students, the word marginal represents, what is it? The word marginal represents additional. Marginal represents additional. So it is also called additional cost of capital. Let us take the company which raised approximately equity. This company raised 40, preference 10, debentures 30. So totally it raised 80 lakhs, right? Now that company again dire need of additionally 20 lakhs again, 20 lakhs. So they are going for expansion, they may go for modernization, any other purpose, they will go for that. So now the company will ask you in such a way that, sir, already 80 lakhs I raised, now I am going to raise additionally 20 lakhs. That 80 plus 20, 100 lakhs I am going to do. With 100 lakhs I am going to do the business. Could you please tell me weighted average cost of capital for this 100 lakhs? Because additionally company raised that 20, with the 20 plus this 80, total with the 100 lakhs. So that is called marginal cost of capital. Marginal cost of capital means it is the cost of capital estimated only when company raises, what is it? Additional funds. This is, I will show you here, marginal cost of capital. First of all, I would directly give you in wonderful manner with the question and answer. First, let us take, what is marginal cost of capital? The word marginal indicates additional. Word marginal indicates additional. Marginal cost of capital is the additional cost of capital estimated when company raises what funds? Additional funds. Additional funds. So how it is to be calculated? Sir, how to calculate? Similar to weighted average cost of capital. No much difference. So how to calculate marginal cost of capital? Step 1. Estimate specific cost of each source. Each source. Along with the additional source also. For example, equity, preference, debt is there. Now you are going to raise additional funds, either equity, preference, whatever the sources you may raise it, that additional funds, you consider that one also. So marginal cost of capital also can be estimated by using product method or proportionate method, doesn't make any sense, right? What are the points must be remembered calculating marginal cost of capital? This would be the damn important point, but I'm very happy and love to talk to you with respect to this. This is the most important. Here, what are the new point to be kept is that the newly raised source cost of debt, if the newly raised funds are, suppose raised, the newly required funds or new funds raised, either equity, preference, debt, whatever the sources. But if it is raised by issuing debenture, then cost of equity must be recalculated. Cost of equity recalculated. Why, sir? Why? See, already debt is there, right? Additionally, you are raising a debt. As a debt proportionate increases, equity shareholders' risk may increase, you know. In that case, when risk increases, equity shareholders convey their risk in three ways. They may ask you that dividend to be increased. They may ask you that growth rate may be increased. They may ask you that market price may decrease. Market price not decrease. They are not willing to pay that much of price for the given share. That much of price for the given share. So these are the impact. So you try to read problem carefully. Because of rising additional funds, if at all dividend is increasing, market price decreasing, growth rate is increasing, means there is a risk element to equity shareholder. This risk element must be considered and again recalculate. So dear students, in weighted average cost of capital, if you want to calculate it, you have to consider two things. Number one is, what are the source in which you supposed to raise the funds? That cost you must calculate it. Number two is what would be the impact of equity shareholders, whether equity shareholders risk is increasing or not. If it is really increasing, you must consider it. Got it? Right. Now I will show you how this cost could be calculated with the support of the given problem itself. So you see, the first part we completed. Let us come to B part. Compute new weighted average cost of capital. Compute new weighted average cost of capital. If company raises additional funds of how much? 20 lakhs. If company raises additional, already 80 lakhs is there. Now the company additionally raises 20. 80 plus 20 with 100 lakhs, the company is planning to do business. For that, the coupon rate would be 15%. See, previously company raised debt to 30 lakhs, but the rate of interest is available at 14%. But now it is a 15%. What do you mean of this? Here, not only risk of equity shareholders, but also there is a risk to debenture holders. While going on asking money by going on issuing debenture, the risk element of the debenture holders also increases. With effect, he will charge a high rate of interest. High rate of interest. So 20 lakhs he is rising at a debt. So try to understand, if you rise 20 lakhs by issuing a debenture, the rate of interest increases from 14 to 15%. 14 to 15%. Whereas debt amount will increase from 30 lakhs, already old debt is there. If you rise this 20, 30 plus 20, 100 lakhs, 50% in total. Total out of 100, 50% would be a debt only. With effect, equity shareholders risk certainly will increase, you know. What do you say? Increase. This would result in increase in expected dividend 3 rupees. Expected dividend. Previously, how much dividend? 2 rupees. Now dividend to be paid how much? 3 rupees. Equity shareholders risk increasing. So they will compensate, they will expect more dividend, more growth or less price. Here, market price is to be 3 and leave the growth rate unchanged. We said that keep the growth rate aside. But the price of the share will be 15. Previously, how much the price is? 20. Now the price came to 15. That means the equity shareholders not willing to pay 20 rupees for the given share. Not at all. Why? Because your company debt proportionate is increasing gradually. Even though company earns EBIT, wonderful EBIT. How do EBIT will get? Sales, EBIT, sales minus variable cost, contribution less fixed cost, you will get the EBIT. Even though company has a EBIT, as a equity shareholder, I cannot get EBIT directly income to me. It's not income to me. Why? Because from the EBIT, company has to pay interest. As a debt proportionate increases, entire EBIT would be consumed by interest itself. So that is the reason why equity shareholders expects more KE. When company rises, more debt, dear students. That's the point to be kept in mind. Wonderful point it is. So now in part B, I have to calculate marginal cost of capital. Just keep it your entire attention at me, and I'm going to solve this one, how we should estimate it. Marginal cost of capital. Just now I considered how to calculate marginal cost of capital. Sir, same step, sir, same procedure. Step 1. Estimation of specific costs. Each of the sources. Okay, what are the sources? A. First of all, cost of equity. Cost of equity. By raising this cost, what happened? DPS 1 from 2 rupees to it went to 3 rupees. B. Market price. Previously market price 20, now it is came 15. What about growth rate? Growth rate is said unchanged. Unchanged means the 7% growth rate as usually you can take it. Now calculate cost of equity. You can estimate KE. KE equal to DPS 1 divided by market price plus growth rate. So how much the DPS 1 here, dear students? DPS 1 is 3 rupees divided by market price 15 plus 0.07. Calculate it. 3 divided by 15 into 0.07 into 100. You will get it 14. How much you will get it? KE. 3 divided by 15. 120 plus 7. 27% you will get it now. 27%. This is with respect to cost of equity. Next, what to do is cost of new funds you are raising, cost of new debt. P. Cost of 15% debentures, where KD, that is nothing but new funds, new debentures. For new debentures, coupon rate is 15%. You will get the tax rate 1.0.50. Tax rate is 50%, right? Tax rate 50% means you will get it at 7.5%. Thereafter, cost of old debenture, that is nothing but 14% debenture. We already calculated, there is no impact on this. That would be 7%, actually 14. Previously, here we calculated cost of old debenture, how much? 7%. Preference also will remain same, 10%. Cost of preference also 10%. Now you can calculate marginal cost of capital, step 2. Right, dear students, the next step is, step number 2 is estimation of weighted average marginal cost of capital. Let us take estimation of marginal cost of capital. Sir, for marginal cost of capital, what technique should we use, sir? You can use product method, you can use a proportionate method, whatever the technique you want to take it, you are allowed to take, these students, no problem. Here I will tell you first of all the formula how to write it. So marginal cost of capital, I am going to take it a proportionate method, where KE equal to KE into equity share capital divided by total capital employed plus KP into preference share capital divided by total capital employed plus KD, that is already two dips are old and new. For the sake of new I am taking here new 7 debt capital divided by total capital employed plus KD old also is there enough, where you can say debt capital divided by total capital employed. You can take like this. Now you can calculate weighted average cost of capital. You see KE, how much the KE? Now 27% we calculated, I think 27%. So take the values here, 27% into equity share capital, how much it is? 40, already 40 old one, 40 divided by 100, 20 added, you know. Next preference KP 10%, 10 divided by 100. Old new debentures 7.5%, you are raised 20 divided by 100 plus old debt 7%, 30 divided by 100. Okay. Now for the calculation purpose we will calculate 40 divided by 100 into 27%. If you convert it would be 10 point, you will get it 10.8% plus 10 divided by 100 into 10 divided by 100 convert into percentage, this would be 10%. So now make a calculation, 40 divided by, now let us take calculation, 40 divided by 100 into 27% plus 10 divided by 100 into 10% plus 20 divided by 100 into 7.5% plus 30 divided by 100 into 7%. You will get it 15.4 approximately, you will get it, ma. For this better calculation, yeah, I made it a PowerPoint presentation also, 15.4% you will get it. You see, I made it as some presentation for you. Part B, estimation of marginal cost of capital. Cost of equity, DPS 1 3, growth rate 7, market price 15. KE, DPS 1 divided by market price plus growth rate equal to KE 3 divided by 15 plus 0.07, that equal to 27%. 10, 7, 15, 7.5, you see it, 15.4%. Okay, and the last bit also he asked it, last bit, what would be the, if growth rate remain constant, So estimation of marginal cost of capital when growth rate increased to 10%, not constant. This model we discussed that K growth rate is 7%, but if growth rate increased to 10%, in that case what happens? Only KE you must recalculate, that's enough. So step 1, estimation of specific cost. Cost of equity, DPS 1 3 rupees. Growth rate 10% you have to take. Market price 15. So KE equal to DPS 1 3 divided by market price plus growth rate. DPS 1 divided by market price plus growth rate. 3 divided by 15 plus 0.13 equal to 30%. Is it 30? 3 divided by 15 into, yeah, 100 plus 20 plus 10, 30. Thereafter old preference 10, debentures 7, cost of new debentures we calculated 7.5%. Now you can calculate weighted marginal cost of capital. Estimation of marginal cost of capital when growth rate increased by 3. Total growth rate would be 10. There is old 7 plus 3. So now marginal cost of capital KE. Here the formula we know that KE into debt cap equity share capital divided by total capital employed plus cost of preference share capital divided by total capital employed plus old debt KD into debt capital divided by total capital employed plus new debt KD into debt to capital divided by total capital employed. So 40 divided by 100 into 30% plus 10 divided by 100 into 10% plus 30 divided by 100 into 7% plus 20 divided by 100 into 7.5%. 40. Once again I will check. I calculated already into 30%. 30. Yeah, 16.6%. This would be a marginal cost of capital you should consider. We discussed how to calculate weighted average cost of capital as well as marginal cost of capital. So, cost of capital is nothing but it is an aggregate cost of various specific sources like KE, KP, KD and KR. What is the marginal cost of capital? When company has a proposal to raise some additional funds, in that case, the company may think like that, think that how much of the cost I supposed to incur by raising that additional funds. So that is called marginal. The word marginal is nothing but additional. Whenever company raises additional capital, so along with the existing plus additional overall cost of capital is considered to be marginal cost of capital. That we already discussed yesterday. So today's class is how to calculate weighted average cost of capital basing on book value, basing on market value, right? What is a book value? What is a market value? Dear students, a company may issue a securities basing on its issue price. That would be recorded in books of accounts. That is called book value. For example, 1 lakh shares, 110 rupees each, 10 lakhs. That is book value. But the current scenario, basing on the performance of the company, basing on future business growth, basing on proper management of business, sometimes the people might buy the shares. With effect, the market value of the share with respect to stock market will increase, may increase. So when the 10 rupee share value may be now currently 20 or 30 rupees, it may be, suppose you project it, that it may be 20 or 30. In that case, when the company wants to calculate weighted average cost of capital, on what value it has to be taken, book value or market value. Suppose if you take a book value, what is the use? The point is, before going to book value and market value, let me ask you a straight question is that, why a company calculates cost of capital? Tell me please, why a company calculates cost of capital? So it is a first class, I told you, again today also I am repeating the same question. See, cost of capital for the sake of whenever the company goes for investment, the investment project gives you IRR, but that IRR never be called IRR when it is a greater than financing cost, right? So cost of capital is needed to assess the risk element. Okay, to know the performance, there are several reasons we used to calculate cost of capital. Particularly when we are financing, we are going to take financing decision and investment decision. In that scenario, cost of capital plays very, very crucial role. So when you are going to make investment decision and that project is going to give an IRR and you want to calculate cost of capital, if you take a historical value, nothing but a book value, will it good or is it good? No, it's not useful for you. Why? Because today market value of the share is 50 rupees, whereas book value of the share is 10 rupees. By taking 10 rupee share value, if you calculate market weighted average cost of capital, so that weighted average cost of capital is useless because you cannot compare with IRR. So when we take weighted average cost of capital basing on book value, so book value is called historical value, which it's not going to project the real position to the company. But if you take market value means current scenario, current value, present value. So nothing but, dear students, number of security into book value is called total book value of the securities. Number of securities into market value is nothing but market value. Okay, so when you take market value, it represents real current position. That's an accurate one. But the point is, once you take market value of in the process of calculation of weighted average cost of capital, even if you calculate within a fraction of seconds, the market value comes down because market value is never be constant, right? It gets always fluctuated. Such a fluctuated value, taking and considering weighted average cost of capital is not really project the cost of capital of the company. Because if you take 50, you calculate it, and if you want to take a decision, immediately the market value come down from 50 to 20. In that case, what happens? If it increases to 100, in this case, what happened? So, for everything, there is some positive points, there is some negative points. But you have to understand both the things. Simply, from the above discussion, you should understand weighted average cost of capital can be calculated by taking book value. Weighted average cost of capital also can be calculated by taking market value. You can calculate any of the thing basing on requirement of the company. But any of the methods, value may changes, but to calculate weighted average cost of capital, the way of calculation of specific cost will remain always constant. Same specific cost will be applicable to both the values, either book value or market value. But one point should be kept in mind, that whenever you are going to calculate weighted average cost of capital basing on market value, equity shareholders funds, reserves and surplus, any undistributed profits belongs to equity shareholders should not be considered. Should not be considered. Why? Because when you are speaking about the market value, because of this reserves and retained earnings and undistributed profits, all these things indirectly increases the market value. The market value there means indirectly it's a projected. So indirectly it considered. So that's why don't take what? Equity shareholders funds, only equity shareholders funds you have to take. Any reserve, surplus, undistributed profits you should not consider. So that is the important point. Weighted average cost of capital, book value and market value. Now we are going to take problem number 25 to give a 100% clarity with respect to weighted average cost of capital basing on book value and market value. So let us take the problem number 25. Calculate weighted average cost of capital using the following data: book value weights, market value weights. Okay. The capital structure of the company as under: debentures, 100 per debentures, 5 lakhs. Preference shares, 100 per preference shares, 5 lakhs. Equity shares, 10 lakh, 10 rupees per share. How many shares then? It would be 10 shares, 10 per share, 2 lakhs means 20 lakhs there, 10 rupees means how much? Sorry, not 2 lakhs. 10 lakhs amount, 10 rupees each, 1 lakh shares. The total capital employed is 20 lakhs. Okay. Now, market price of the securities. Debentures, 105. Preference shares, 110. Equity, 24 each. So, additional information. 100 per debenture redeemable at par. 100 per coupon rate. See, 100 per debenture redeemable at par. 10% coupon rate, 4% flotation cost, 10 years maturity. It is saying that, it's very clear that debentures are redeemable in nature. The coupon rate of interest would be 10%. Redeemable period is 10 years. Flotation cost is 4%. So, here redeemable value is 100, but issue value is not given. So, you can take an assumption that it is a face value. Next, 100 per preference shares, redeemable at a 5% coupon rate, 2% flotation cost and 10% maturity. Coming to preference shares also, 100 per preference shares, redeemable at par, 5% coupon rate. Coupon rate is how much? 5%. 2% is flotation cost. 10 years is the maturity period. It is also redeemable in nature. Equity shares have 4% flotation cost and market price is 24. Market price, current market price is 24. So, the next year expected dividend would be 1 with annual growth rate of how much? 5%. The firm has a practice of paying all its earning in the form of dividend. So, corporate tax rate is how much? 50%. Corporate tax rate is 50%. So, this is the formula. So, not this is the problem, we have to identify it. See, actually debenture value is 100, now it is 105. Preference share is 100, now it is a 110. Equity share is 10, now it is a 24. Okay. So this is the problem which is there in study material, but the point is the same problem recently in RTP November 2020 also given. I worked out the same problems in there and in classroom also. But in classroom, if you take an assumption that issue are made at a face value, debentures, even though market value, you see the debenture is 105, but issue made at face value. If you take that assumption, the accurate answer will come, which is given in your study material. But in RTP, they took an assumption that the issue is made at a market value. So if there is no direction in the problem, you don't go for, you are allowed to take any of the ways, any of the methods or any of the approaches. Either you can go with the issue value, either you can go for market value. So now weighted average cost of capital basing on book value and market value, we have to find it out. Let us take. See, first of all, you should understand the specific cost of each of the sources. Specific cost of each of the sources. Let us take estimation of weighted average cost of capital. In this case, what you have to do? You have to calculate specific cost. What are the various specific costs? Equity is there, preference is there, debenture is also is there. So you have to calculate first specific cost. Then you have to take book value and you have to calculate weighted average cost of capital. Then you have to take market value. Then you have to calculate weighted average cost of capital basing on market value. Here in this problem, there is no retained earnings, there is no any undistributed profits, nothing is given in this problem. So that's why you can comfortably calculate it. If there is a retained earnings, then as per market value, you should be ignored. It must be ignored. Whereas weighted average cost of capital, you are calculating from book value point, you must consider it. Such a contradiction issue point is not in the problem. So it would be very easy to calculate. Coming to cost of estimation, here estimation weighted average cost of capital, what value we will take it? Estimation you have to take book value, estimation you can take market value. Weighted average cost of capital basing on book value, one is, another one is estimation of weighted average cost of capital basing on market value here. Market value. Okay, let us, I am saving this one. Coming to first one, we will go for cost of debt. Cost of debt, how do you calculate cost of debt? Cost of debt is redemption made at the end of the period. Since coupon rate remain constant, you take here is since coupon rate remains constant, since coupon rate remain constant, redemption is done at end. Redemption is done at lump sum. Redemption is done at lump sum. In this case, you can use what method? You can use a shortcut method. Shortcut method formula, cost of debt equal to interest into 1 minus tax plus redeemable value plus net proceeds divided by n number of years whole divided by RV plus NP divided by 2. So this is the shortcut method you can use because of the following condition exist here. Okay, now interest, how much the interest? Interest is given at 10%. Now tax rate is also given. Interest into 1 minus tax rate. What is the tax rate given in the problem? 50% tax rate. 50% tax rate means interest into 1 minus tax rate. So coupon rate, here you have to write tax rate, Sir, pause చేసేసాను సార్. solve the problem number 23. That is a problem. సార్ దీని ఎక్స్ప్లెనేషన్ అంతా చెప్పేశాను నేను. ఇప్పుడు సాల్వ్ చేసేటప్పుడు పవర్ పాయింట్ కాకుండా మామూలుగా మాన్యువల్గా చేసి చూపిస్తాను. ఇక్కడనే తీసుకోండి. సో లెట్స్ సాల్వ్ ద ప్రాబ్లమ్ నెంబర్ 25. దట్ ఈస్ నథింగ్ బట్ వెయిటెడ్ యావరేజ్ కాస్ట్ ఆఫ్ క్యాపిటల్ బేసింగ్ ఆన్ బుక్ వాల్యూ, weighted average cost of capital basing on market value. Dear students, okay, let's take a notepad and we will jump into there and we solve the problem. So problem number 25. Problem number 25. See, in this problem, dear students, we have to calculate weighted average cost of capital. We have to calculate basing on book value and weighted average cost of capital basing on market value. So this is the problem you supposed to learn in this class. Okay, right. First of all, you have to do step number 1. What to do? Step number 1 is you have to estimate specific cost. Specific cost of each of the sources. What are their? Equity, preference, debentures are there. So estimation of estimation of specific cost of each of the sources. Specific cost of each of the sources. So what are the sources which are available? Number 1. First we will calculate cost of equity. Cost of equity. What is the data given with respect to cost of equity? DPS1. DPS1. Let us check the problem once again. We will go there and we will find the data. Here DPS1. Equity shares 4 rupees, flotation cost, market price is 24. Expected dividend is 1 rupee, growth is 5%. Right. So cost of equity given DPS1 1 rupee. Growth rate is 5%, I think 5%. Market price 24 rupees. Flotation cost, that is nothing but 4 rupees. From the given data you can calculate what is that? Cost of equity, where cost of equity equal to DPS1 divided by net proceeds plus growth rate. DPS1 1 rupee divided by net proceeds 24 minus 4 20 plus growth rate 0.05. Let us take a calculation. You take a calculation. 1 divided by 20 plus 0.05 into 100. You will get it at 10%. So KE is nothing but a 10%. This is with respect to cost of equity. Cost of equity equal to 10%. Okay, right. Next we have to calculate one more thing is B, cost of debt. Since coupon rate remain constant, redemption is done at lump sum. See, we can take point 1. Since coupon rate remains constant, and the redemption is done at lump sum. So in this case we can use what method? You can use a shortcut method. So what would be the shortcut method formula? Shortcut method formula is cost of debt equal to interest into 1 minus tax plus redeemable value minus net proceeds whole divided by n number of years divided by RV plus NP divided by 2 into 100. So this would be the formula for cost of redeemable debentures. Let us post the values. What is the values given to you and how you supposed to calculate? So for the interest, the coupon rate is given. So cost of debt equal to coupon rate is given 10, tax rate 1.050 plus redeemable value is 100. What about the net proceeds? That is a contradiction issue. So net proceeds issue can be done at market price, issue can be done at face value. So in this problem which is given in your study material, they have taken an assumption that issue made at face value. How much the face value? 100. You are issuing 100. But flotation cost is there, in flotation cost they are given as a 4 rupees, I think. 4 rupees, sure. 1 minute, we will check it there. Flotation cost is 4%. Flotation cost is 4% on what value? On issue value. So in this case, 100 rupees into 4, you will get the 4 rupees. 100 minus that 4, nothing but 96. Divided by 10 years. 10 years. Whole divided by RV plus NP divided by 2. N number of years. Okay. So, Balu sir, when market price is better, and market price is around 110 something is there. So why don't you go for market price? Of course, either you may issue the debentures basing on market value, you may issue the debenture basing on face value. That is your assumption. When client could not convey his ultimate opinion, then how do you take a decision, man? So he has to say that I need weighted average cost of capital basing on book value or market value. So I will issue the shares at a book value or market value. If nothing is given in the problem, so you can take any of the methods, no problem. So I am taking an assumption that issue made at what value? Face value. In that case, let's make a calculation. So 10 into 1 minus tax rate, you will get the 5%. 5 plus, here you see 100 minus 96 divided by 10. So it's nothing but 100 rupees you are taking, 96 you are paying. So your burden is increasing. That is nothing but 0.4 divided by 100 plus 96 divided by 2, that equal to 98. Convert into percentage. So here 5.4 divided by 98 into 100. You will get it a 5.51%. 5.51%. This is with respect to cost of debt. This is with respect to KD. So KD would be 5.51%. Okay, ma? Dear students, we are taking an assumption that issue made at what value? Face value. Debentures, I am taking debentures and preference both are issued at market value. Equity will be issued at, debenture and issue both are issued at face value, whereas equity issued at market value. That's my assumption. Okay, you can take all are in market value, all are in face value, nothing else. But institute, CA institute, whatever the answer is given basing on this assumption, that's why I am teaching the same pattern. Okay, coming to last one, you have cost of, third one, cost of preference. Cost of preference or redeemable, redemption is done at lump sum. That coupon rate of preference also remains same. That's why you can also use what method? Shortcut method, where KP equal to preference dividend plus redeemable value minus net proceeds divided by n number of years divided by RV plus NP divided by 2 into 100. 2 into 100. Now, how much the preference dividend which is given in our problem? You see it. Let us check. So preference shares 100 per share, here 100 per preference shares, 5 rupees is a coupon rate, 100, 5 rupees coupon rate, 2 rupees flotation cost, 10 years, that's enough. So preference dividend, how much the preference dividend which is given in your problem is 5, redeemable value is 100, so 4 rupees is a flotation cost, it means 4 rupees, 100 rupees, not 4 rupees, getting confusing, just wait 1 minute please, let me check it again. Here 100 rupees preference shares, 2% is the flotation cost man, not 4, that means 98 you got the net proceeds. So 98 divided by 10 whole divided by RV plus NP divided by 2. So here 5, let us take here 5 rupees as usually, you are taking 98 and you are giving 100. It means that you got the 2 rupees of loss. If you distribute it for over the 10 years, you will get it 0.2 divided by 100 plus 98 divided by 2, you will get it 99. Convert into percentage. So 5.2 divided by 99 into 100, you will get it 5.25 percentage. So this is with respect to calculation of cost of preference. Calculation of cost of preference. So now you have a data of, you calculated cost of equity, cost of debt and cost of preference also. Now you can calculate part A. What's a part A? That is part A. Okay, let's take weighted average cost of capital. Dear students, weighted average cost of capital can be estimated basing on book value, basing on market value. That's we know that. But what are the methods you can take it? Either you can take it a product method or proportionate method. So weighted average cost of capital basing on book value, market value, it is the problem actually. In calculation of weighted average cost of capital, either you can take it a product method, proportionate method. Whatever the technique you can use it, it doesn't make any sense, it will give you the same answer. Now, I am going to calculate weighted average cost of capital. So, step number 2. So, estimation of weighted average cost of capital basing on book value. These students, in book value is given in your problem. Book value is given in your problem. So you can take a proportionate method, that's weighted average cost of capital basing on BV, book value equal to KE into equity share capital divided by total capital employed plus KP into preference share capital divided by total capital employed plus KD into debt capital divided by total capital employed. So we know that the what is a KE, we calculated KE is nothing but 10%. What is the equity share capital in the problem? 10 out of 20 plus KP, if we calculated 5.51 actually, KP 5.51, it's a 5.2, let me check again. In the above only, we calculated. Cost of debt is 5.51, cost of preference is 5.25. So 5.25 into 5 divided by 10 plus 5.51 into 5 divided by, no, this is 5 divided by 20, 5 divided by 20. So now you can evaluate the answer. Answer would be approximately 7.68%. It would be 7.68%. Let me check it once again. 10 divided by 20% into 10%. It would be 0.05 and plus. So 5.25, 5 divided by 20 plus 5.51 into 2 divided by 20. Sum it up, 7.68% you will get it. You verify it. If you take the factor values, where is any factor value, then answer will changes. That's enough. So this is the estimation of weighted average cost of capital basing on book value. Now we can calculate a weighted average cost of capital basing on market value. How it should be estimated? Let us take step number, another part B. Part B is there where you can calculate estimation of weighted average cost of capital basing on market value. So for the market value, if you want to find it out, so you have to calculate the market value and specific cost. Here you can take what are the sources which are available to you. Take the sources and you can take market sources, you can take amount and you can take specific cost each of the sources, and you can multiply with, you will get the product value. Okay. Now first of all you will take equity share capital. Total equity shares which are available is how many shares? 2 lakh shares. You see the problem? If you observe the problem, equity shares 10 lakh shares, not 2 lakhs. 10 lakh share capital, 10 rupees each, means 1 lakh. 1 lakh into current market price is 24. It means that 24 lakhs would be the market value for you. So 24 lakhs. So now the cost is 10%. So 24 lakh into 10%. 24 lakhs into 10%. That would be 2,40,000. Thereafter you have preference shares. What is the amount of preference? How many shares? Total 5 lakh 10 rupees each. 50,000. Current market value of preference is 110. So 50,000 into 110. 5,50,000 rupees. Actually here you see not a 5 lakh worth is there, 100 rupees each, it's nothing but 5,000. So 5,000 into 110, 5,50,000. Preference 5,50,000. What the specific cost which is given for preference is 5.25%. 5.25%. So 5,25,000 into 5.25%. That would be 28,875. Whereas third one, debentures are given. Debentures. So debentures also 5,000. Each value now currently how much the market value? That would be 5 lakhs. Each is 100 rupees. So 5,000. 5,000 into current market price is 105. 5,000 into 105. That would be 5,25,000 rupees. So 5,25,000 rupees. 5,25,000 into debenture cost is 5.51%. 5.51%. So 5,25,000 into 5.51%. 5,25,000 into 1%. So 28,928. 28,928. This is the total cost you supposed to pay for market value of this debenture. Let's sum it up, the total market value, that equal to 24 lakhs plus 5.5 lakhs plus 5.25 lakhs, that equal to 34 lakhs 75,000. 34 lakhs 75,000 would be the would be the market value. For that purpose, how much you are paying? 2.4 lakhs plus 28,000. 2.4 plus 0. So 2,40,000 plus 28,875 plus 28,928. It would be 29,000. 2,97,803. This would be the market value total. Now for 2,97,803 you are paying for rising of 34,75,000 with respect to market value. Debenture value today is this much. For this much amount you are paying this much. Convert into percentage. That's why weighted average cost of capital basing on market value. How much it would be? You are paying 2,97,803 for 34,75,000. Convert into percentage. You will get the answer. Weighted average cost of capital 34,75,000. It would be 8.56%. So this is the, dear students, the problem with respect to weighted average cost of capital. Try to understand how I estimate it. I calculated first specific cost, cost of equity, then I calculated cost of debt, then I calculated cost of preference, then I calculated estimated weighted average cost of capital basing on book value, and estimated weighted average cost of capital basing on market value. So this is the problem. With this we concluded this problem. Thank you. Okay, dear students, in first problem we discussed weighted average cost of capital calculation basing on book value and market value today's class. Yesterday I told you how to calculate weighted average cost of capital and marginal cost of capital. In examination point of view, one more problem also very important. Again we are going to calculate that one. In our study material this problem is there as problem number in marginal cost of capital, Areas Limited. It's a very good problem. So we will work it out, that problem. Okay, dear students, let's do. Problem number 26, we are going to evaluate. Areas Limited wishes to raise additional finance of 10 lakh for meeting its investment plan. How much they needed? 10 lakhs is needed. It has 2,40,000 in the form of retained earnings. So it's retaining how much? 2,10,000 rupees. 2,10,000 rupees is the retained earnings. So dear students, retained earnings are funds belongs to whom? Equity shareholders. Retained earnings are funds belongs to equity shareholders. So the retained earnings which is available, but actually they needed 10 lakh. Got my point? Right. The debt equity mix is 70%. Sorry, debt equity mix is 30%, 70%. So what do you mean of this? What do you mean of this? It indicates that this is the company's optimum capital structure. Whenever the company need a capital, it will raises the debt only 30%, to the extent of 30%. Whereas for equity, to the extent of 70%. So that is the debt equity mix of this company. The cost of debt is up to 1,80,000, 10% before tax. When you calculate cost of debt, okay, you never take before tax, man, because you are going to get tax advantage. That's why you have to take always post tax. So up to 1,80,000, the 10% is the post tax, but you have to take only after tax. That is nothing but you have to take post tax. Still I don't know how much the tax rate is given in the problem, but at present segment I can say that you should not take 10%. It is a before tax, you have to take after tax. That is a point. Beyond 1,80,000, that would be 16%. This is also before tax. So why this happens? Why as amount of debt increases, the coupon rating is increasing? Because the risk element of debenture holder. When you raises funds from the debenture holders, consequently, automatically the risk element of debenture holders increases. Then he will charge high rate of interest for compensating his risk, man. Not only risk to equity shareholders, but also risk to debenture holders also available. They will also feel, because they are also investors. They are also investors. Next, the earning per share is 4 rupees. Dividend payout ratio 50% of the earning. How much they are paying? 50% they are paying. From the earnings, they are paying 50%. Expected growth rate is 10%. Expected growth rate is 10%. Current market price per share 44. So the tax rate is 50%. The tax rate is available is 50%. Here they are asking, determine pattern for rising of additional finance. Additional finance. Then determine post-tax average cost of additional debt. Determine cost of retained earnings and cost of equity. And finally, they are asking, compute the overall weighted average after tax cost of additional finance. So this is the, dear students, the problem is. So simply, what is the problem? Areas Limited company needed 10 lakhs for investment, but 2,10,000 of retained earnings is available in their hands. Their optimum capital structure is 30% debt and 70% equity. This is their customary, that they used to raise funds only this level. But if you observe the coupon rate which is applicable for debenture is up to 1,80,000 rupees, they will charge 10%, but this is before tax. Just now I told you that you should not take 10% because you are supposed to get tax advantage on paid interest. Beyond 1,10,000 to 1,80,000, the rate of interest to be applicable is 16%, that is also before tax. The earning per share is 4 rupees. Out of that, dividend pay is 50%. It means you are earning 4 rupees. Out of that 50%, you are paying a dividend. The expected growth rate would be 10%. The current market price is 44. Tax rate is 50%. This is the beautiful problem, wonderful problem. Here asking, determine pattern of rising additional finance. Determine the post-tax average cost of additional debt. And determine cost of retained earnings and cost of equity. And overall cost of capital. Shall we take now? Right. First of all, pattern 1, determine, this is problem number is 25 in your material. Check it once again, please. Problem number 25. Okay, right. Problem number 1, part 1, estimation of pattern of rising additional finance. Let us see. Total, how much they needed? 10 lakhs needed. Out of that, 2,10,000 they have retained earnings. Okay. So here they are asking how much the pattern should be raised. Additional finance should be raised. How much the additional finance? Determine the pattern of rising additional finance. You see. Pattern of rising of additional finance. Additional finance. How company rises additional finance? Let's check it. Here, capital required. Actually, capital required or finance required is 10 lakhs. This is. Whereas out of this, how much debt they are planning? Debt at 30%. So how much debt they will rise means debt amount. In the form of debt amount, how much they will rise means from the 10 lakh rupee into 30%. that equal to 3 lakhs rupee would be the debt. Coming to equity. Equity at 70%. But generally 7 lakh they won't raise, dear students. Why no? If they rise 7 lakh rupee, already 2 lakh 10,000 retained earnings are there. Then 7 plus 2 lakh 10,000 total 9 lakh 10,000 will be there. In that case, debt equity ratio doesn't work out here. It doesn't work out. So that's why what you have to understand. So how you have to rise it? So first of all, the equity. How much the equity must be there? Equity capital must be out of 10 lakhs into 70% means you must have 7 lakh rupee. 7 lakh must be there. But less you have to deduct what is that? Less retained earnings, which is available. Retained earnings, that is 2 lakh 10,000. If you deduct retained earnings, two lakh 10,000, then the net aggregate amount comes to in your hand is 5 lakh 10,000. So the equity to be issued is nothing but equity to be issued. Equity to be issued is how much? ₹5 lakh 10,000. So debt would be how much, dear students? 30%. You means 3 lakhs you can raise it. For equity 70%. But out of this 70, you should not raise 7 lakhs because already you have a retained earnings of how much? 2 lakh 10,000 rupees. So finally you have to issue equity only 5 lakh 10,000 only. For this purpose you will get 2 to 3 marks. Got my point? Good. Next, first bit is finished. What is the second point they asked is? The second point what they asked is the pattern of rising is first bit. Second bit is determine the post-tax average cost of additional debt. Post-tax average cost of additional debt. Okay. Post-tax average cost of additional debt. How much the tax overall cost of capital for applicable for only debt, not overall cost of, this is the cost of debt actually they are asking. So how to calculate? See, part B. Estimation of post-tax average cost of debt. Post-tax average cost of debt, how much it would be? How do you calculate this? Sir, total 3 lakhs, you know, sir. There 10%, one aspect it is a 10%, another aspect it is a 16%, I think so, right? One is a 10, another one is a 16%. So how do you calculate? What to do, sir? Again, that is a before tax, man. What to do? So first of all, you should not take before tax. You have to convert into post tax. That value should be taken out. Okay. Now what to do is, so amount of debt you take it. Amount of debt. First, initially they are taken 1,80,000. For 1,80,000, the cost of debt, that is post tax, not pre-tax. Don't take post tax. Don't take a before tax. You take post tax after, because you will enjoy tax advantage. So what is the tax rate given in your problem? What is the tax rate given in the problem? The tax rate is given in our problem is 50% tax rate is given. 50%. So actually up to 1,80,000, 10%. In that case, 10 into 1 minus 0.50, that equal to 5%. So now convert into product. For product, how much you supposed to pay? For 1,80,000, 1,80,000 into 5%, that is 9,000 rupees you have to pay for first one. Thereafter, total you are raising 3 lakhs, okay. 1,80,000 already you raised. So what to do is 3 lakhs minus 1,80,000. Then you have to raise the next amount would be to 1,20,000, because finally you have to raise only 3 lakhs, the total would be 3 lakhs. So for this 1,80,000 they said that 16%. 16% into 1 minus 0.50 means you will get 8%. So 1,20,000 into 8%, that is 9,600. So for first option, up to 1,80,000 you have to pay 9,000. Thereafter 1,20,000, 9,600. So 9,000 plus 9,600, 9,000 plus 9,600. If you add it, 18,600. 18,600. So weighted average cost of capital, nothing but how much? For 18,600 divided by 3 lakhs into 100. 6.2%. 6.2%. So this would be weighted first part, second bit answer, that is estimation of post tax. 6.2%. Then you have to calculate cost of equity, which is given in your problem. So equity, which is you have to find it out. With respect to equity, what to do? What is the data given to you? Determine cost of retained earnings, cost of equity. These students, cost of retained earning, cost of equity, I already explained, When you are calculating cost of retained earning, there are two approaches. Number one, believing that retained earnings are funds belongs to equity shareholder. In that case, KE equal to KR. But point is that equity which is going to be considered as KR must not have retained earnings. Sorry, flotation cost. The another point is cost of debt. Sorry. Another point is net opportunity cost to benefit of equity shareholders. If the equity shareholders, if they would have invested these funds somewhere else, what is the net benefit they are supposed to earn it? For that purpose, what I told you. So cost of retained earning equal to investor expected rate into 1 minus brokerage. By chance, if they would have invested brokerage expenses, deduct that one. And thereafter, tax rate is given, then you consider this one. If nothing is there, nothing brokerage, next tax rate is given, then tax rate means personal tax rate. It's not a corporate tax rate, personal tax rate. So in that case, what happened? KE equal to KR. That is a problem, you can simply calculate it. So in this model, what I am going to do is, first of all, I will calculate KE, dear students. I will calculate KE and I will assume KE equal to KR, because in this problem there is no flotation cost. There is no brokerage, there is no personal tax. That's why I will assume KE equal to KR. Okay, right. Let's evaluate cost of retained earnings. Okay. In 1 hour? This is part C. In this part, we are going to calculate a estimation of, what you are going to calculate? Tell me please. Estimation of cost of equity and cost of retained earnings. Cost of equity and cost of retained earnings. Okay, dear students, now let's come to work. How do you do this one? Given cost of equity, what is the data given to you? Tell me please. Sir, they are given EPS. How much the EPS is? EPS is, here the problem, EPS 4 rupees. Dividend payout ratio 50. Sir, there is no specification with respect to payment of dividend. It's not saying expected to pay, plan to pay, decided to pay, analyzed to pay, declared to pay. It is not. But in this case, EPS is there, but dividend payout ratio is 50%, means it is a dividend with respect to last year. We can take an assumption. So in this case, 4 rupees, growth rate is 10%, market price 44. Okay. Now what is the data given to you is EPS is 4 rupees. Market price is how much? Market price is 44. Growth rate is given in your material. How much the growth rate is given is 10%. So dividend payout ratio is 50%. Since growth rate is given, dear students, what we do is we can calculate KE like this. KE equal to DPS 1 divided by market price plus growth rate. In this problem, we will assume that EPS is how much? 4 rupees. Out of that, company is paying 50%. That is a DPS 0. You have to convert into growth rate. 1 plus growth rate. That is nothing but 110%. Whole divided by market price 44 plus 0.10 growth rate. Sir, why you are multiplying 4 into EPS 50%? That is nothing but dividend payout ratio. So out of 4, 50% is nothing but a dividend paid. So 110 is why? Because it is a growth, DPS 1 to be added. If you 4 into 50, you will get the dividend paid already. You need a DPS 1. For that purpose, you have to consider growth. So 4 into 50%, 2 rupees. 2 rupees into 110 percentage, 2.2. So 2.2 divided by 44 plus 0.10 divided by 44 plus 0.10 into 100, you will get it 15%. 15% would be the cost of equity, dear students. 15%. Now what about the retained earnings, Balu sir? What about cost of retained earning? Since there is no flotation cost, next bit you can write like this: cost of retained earnings. What to write? Since there is no flotation cost, since there is no flotation cost, another one is since retained earnings are funds belongs to equity shareholder shareholders, thus KR equal to KE. That is nothing but 15% only. So this is the beautiful conclusion you can draw. Since I am writing two since for the sake of poetic manner, so that you can easily catch it this one. Since there is no flotation cost, and since the retained earnings are funds belongs to equity shareholders, I come to conclusion that KE equal to KR. And finally, what is left to you is last bit, asked to find it out, marginal cost of capital. That is the ultimate point to be estimated. Compute overall weighted average cost of capital, cost of additional finance. that is nothing but with total amount we have to consider it. Okay. Now you see estimation of weighted average cost of capital. You can use it a product method or you can calculate with the proportionate method. Doesn't make any sense. So okay, dear students, now we are going to calculate last point, that is estimation of marginal cost of capital, or in your material it is given compute overall weighted average cost of capital after tax, post tax. Okay. Now we directly jump into the topic and we will write it out, solve the problem. So part D, that is estimation of weighted average cost of capital. So weighted average cost of capital, you can use product method or proportionate method. Let us take weighted average cost of capital equal to KE into equity share capital divided by total capital employed. Thereafter KR into equity share capital divided by total capital employed plus KD into debt to capital divided by total capital employed. These are the three sources in which the company rising. For KE 15%. So how much equity they raised? Total 10 lakhs is needed. Out of 10, 3 lakhs debt is went off. So total 7 lakhs is there. Out of 7 lakh, you have a 2,10,000 in your hand. 2,10,000. Then 4,90,000 should be raised. 4,90,000. This is the 4,90,000. But first time when I wrote it, I made it as a 5 lakh, right? It's mistake. 4,90,000. So here 4,90,000 out of 10 lakhs plus retained earning also 15%, that is a 2.1 lakh 10 plus cost of debt. How much we calculated? Cost of debt is 6.2%. 6.2%, that equal to 3 divided by 10. Now you can calculate 4.9 divided by 10 into 15% plus 2.1 divided by 10 into 15%. Next 3 divided by 10 into 6.2%. So if you multiply and find it out the value, overall weighted average cost of capital is 12.36%. You will get it. 12.36%. So this is the way to find it out, weighted average cost of capital. Okay, dear students. So weighted average cost of capital 12.36%. You can also use product method. By using product method also you can evaluate it. Right.
Hello students, just now you have watched FMRRB sample video cost of capital, and if you want to watch further videos of financial management RRB, you have to install Masterminds online classes app. We have made these videos in the free video section of our Masterminds online classes app. Now let me show you how to install Masterminds online classes app. The procedure is quite simple. You just click on the Play Store and you just type in here Masterminds online classes. So once you type in Masterminds online classes, now you just click on install, and now the Masterminds online classes app gets installed into your system. And if you are an iOS user, you have to download Class Plus app and you have to enter organization code MJGUN. Yes, now the app is already installed. Just click on open, and if you open the app, the first thing that the app asks is your mobile number. Enter your mobile number here. And you just click on proceed securely. Once you do that, you will be sent an OTP by the app. You just type in the OTP here. That's it. The app is ready. Now you can start watching videos with the app. Now let me show you the procedure of finding the videos. You just click on the 3 lines at the top left corner. You can observe here. You just click there. Here you can find the study material, and here in the study material you find study material and videos. You just select the videos, and now you can see here the first folder, CA Inter FM RRB videos by Balu sir. If you just click on it, you can find the remaining videos. So start watching them. Happy learning. All the best. Thank you.